The market seems to be in new economy dynamics, right? At least for AI.
We are still in the earlier part of the investment cycle.
Call it over a quarter of the economic growth is coming from this AI supercycle.
At this point, I think we're getting into bubble territory.
Whenever demand is very strong and has been for a number of years, one has to always have an eye towards the next downturn.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, gold topping 4K. The precious metal breaking through 4,000 for the first time ever as the Fed is focusing on jobs growth and looking through financial excess. Nvidia is investing in a major funding round for Elon Musk startup XAI. Nvidia is investing in another customer.
At a time where there's a lot of concern about circular financing, the idea that all of the big tech players are investing in one another, and it raises this real key question. There is this feeling that you need to build out your AI capabilities at any cost. So what is that cost, and how intertwined are some of these big companies with one another and with costs that are unidentifiable?
Echoes of vendor financing that took place in the late 1990s. Not a perfect parallel to that era, but ultimately some questions. And I think those questions increasing over the past few weeks.
Do some of these companies become systemically important if they all are intertwined with one another? And if the supplier of goods is financing the purchasing of those goods, all of a sudden you start to wonder, how real is the demand? One thing that was really struck me in a whole host of conversations yesterday was how many people have expensive leases for long-term data center usage that isn't really being quantified in a real way. It just raises the question about where valuations are.
Nvidia this morning higher by about 0.6%. Another move. Check out gold. Gold up for a fourth consecutive session. We are through 4K. We're looking at fresh all-time highs.
And according to Goldman Sachs, by December of next year, we could be very close to $5,000 when it comes to gold. The more uncertain things are in Washington, the more certain people are about putting their money in one place, and that has been gold. And right now, the uncertainty continues down in Washington, D.C. We are in the 8th day of a government shutdown, no end in sight, and this time next week, potentially, our servicemen and women might not get paid. So when things are so uncertain, you don't like the U.S. dollars, you're not too sure about U.S. treasuries, what do? You buy the precious metal.
Not exclusively this time, though, and this week, a dollar-centric move. Look elsewhere. Japan. Look to France. Look to the euro. Look to the yen. The dollar's actually at a two-month high at the moment. It's the weakness elsewhere that started to fuel this extra leg in gold.
The fact that there is no alternative. You might hate the dollar because of the government shutdown and a question of whether the Fed's going to ease at a time that's where there is elevated inflation. Are you going to go to France? Are you going to go to Japan with the idea of stimulating the economy at a time of inflation? It is a global problem. I was struck by the fact that gold rising in tandem with stocks might not be an anomaly. There are the echoes of what happened in the 1970s, where there is a question of how we're pricing things and whether inflation is coming in other places.
Gold this morning through 4,000. Equity futures doing okay, bouncing back by 0.1%. Coming up this hour, Julian Emanuel of Evercore on the prospect of a tech bubble. Ian Lyngen of BMO Capital Markets ahead of the latest Fed minutes, and Rob Sockin of Citi on why the labour market may be at a turning point. We begin this hour with stocks rising and gold at all-time highs. Julian Emanuel of Evercore writing the increased probability of a bubble scenario gives the S&P 500 a 30% chance to rise to 9K by year-end 2026. Julian joins us now for more. Julian, good morning.
Good morning.
It's good to see you, sir. Let's put some meat on those bones. 30% chance of 9K next year on the S&P.
So if you think about it, actually going back to Y2K, right, where all this sort of talk of bubbles originated, over the course of this last 25 years, you have had numerous bubbles: housing, global bond markets, Chinese equities in 2015, meme stocks, this, that, and the other. And frankly, when you add all that up, first of all, academia would tell you that those many bubbles in 25 years is absolutely impossible. But when you think about it, it really does speak to the fact that, number one, each bubble was larger than the last. And from our point of view, when you think about Y2K at 28 times earnings peak, it's very reasonable to think about 30 times a $300 number, getting you to 9,000 in the S&P 500. But it's bigger, more, grander every time.
Well, let's speak to this moment. There are whiffs of vendor financing. We see Nvidia investing in some of their companies. in some of their customers, and we know that money's going to come back to their company. What's different about this moment? It seems to be the strength of the balance sheets compared to where we were in the late 90s and the absence of leverage on those balance sheets of some of the major tech players. Does that give this more legs? Is that how you think about things?
Well, again, when you think about the late 90s, you were having companies that didn't have earnings, that had barely had revenues, that were doing all the spending on CapEx. You don't have it this time. Most of the companies, to your point, have incredibly strong balance sheets. But when you think about what we've heard in the last couple of weeks, the memory for us is this Japanese phrase, karetsu, cross shareholdings. You saw it in the 1980s and the early 1990s, which inflated valuations into the Japanese equity market bubble. And look, if you're not concerned about the potential knock-on effects of all this kind of cross-shareholder relationships, you're probably not paying sufficient attention.
So is this bullish or bearish? You're talking 9,000, which sounds great, let's get in, and then you're talking about a bubble that's bigger than anything we've ever seen before.
And you have to think about it in terms of cycles, okay? What we have been very plain about in getting ourselves around the idea that you invest in a higher valuation environment is this notion that what ends structural bull markets, and to be very clear, what we had in February to April was a cyclical bear market in a structural bull market. What ends structural bull markets is a Fed that's going to be hostile. If anything, the Fed is going to be perhaps too friendly to the point about stoking inflation. Higher yields on the long end. Amazing how quiescent the 10-year yield has been. And then, recession, that doesn't seem to be in the cards. But the last thing, the fact that every one of these capital market cycles has ended with an incredibly robust corporate action pipeline, and we're just starting to see that form, tells you that there's further to run. And as difficult as it is, and it is difficult to invest in these valuations, we think that you need to stay invested.
You need to stay invested in the big tech players. Does it say anything about the rest of the market, or is that just a completely different story in terms of the economic drivers, the areas outside of AI?
Well, look, and again, when you think about the demographics and know that over the course of the coming decades, demographics are going to be a headwind, and they already are in places like China. That's part of why AI has had the impact that it's had. And this year we're seeing other companies, the adopters and the adapters, really start to talk about how they're essentially driving revenue. We always knew the cost-saving story, but that is very, very vital. And for us, when you look at the internals of the market, what's different between now and the late 1990s is that day to day, the advancers are beating the decliners. The troops, the people in the field, the stocks that nobody talks about are going up day in and day out, whereas in the late 90s, it was all tech all the time.
Seeing billions of dollars being put towards AI, but we're not seeing billions of dollars being put towards electricity demand. What happens if the grid can't handle all of this?
Well, that's absolutely a concern. No question about it.
Do you reach 9,000 next year if you can't even develop data centers?
That's a good question. And from our point of view, again, it's less about the synchronization of the build out than the fact that there is sufficient liquidity to really expect the build out to occur over a time. And again, I go back to this idea, and frankly, we're seeing it this week was different. Not only did you have the largest LBO in history, but I took taxi cab rides, and they started talking about the stock market, and they started talking about AI, and that's different, but that's part of every cycle, and that is how you get to valuations that go from rational exuberance, where we are now, to something more extreme.
I'm not throwing shade at all, but I think the cab driver over the past 5 years has been more dependable than the strategist on Wall Street in some ways. Is that fair?
We got cautious like everyone else in March. We got bullish in April, to be clear.
I'm with
But
you. But I don't know if they've been the contrary indicator in quite the same way that they were in the 1920s, 1930s.
Well, what's fascinating, again, is you go back to February through April, and the public got this right. Literally, for the first time in the cycle, the public was the buyer the whole way down. And the reason that the market has been so unrelenting on the upside is because professionals have found themselves underinvested.
It was the shoeshine boy in the 20s. Remember all that stuff? I think the story's really different. The performance chase going into year-end is coming from Wall Street. Wouldn't you agree? From speaking to clients, they missed out on the move in April in the last 6 months.
I would, but I would also say this, is that the dynamics of trading, they used to call it day trading in the 1990s. Now you're looking at high-frequency trading, but these 0 days to expiration options, the gamma effect that causes hedgers to have to hedge upside intraday is really unlike anything I've seen.
Julian, you're going to stick with us, I'm pleased to say. It's not aimed at you, of course. It's aimed at other people out there. Julian Emanuel of Evercore, sticking with us. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. President Trump is threatening to block back pay for some federal workers once the government reopens, saying some, quote, don't deserve to be taken care of. The White House Budget Office has drafted a memo arguing the 2019 law guaranteeing back pay is flawed and doesn't require automatic payment. Democrats call that interpretation an outrage and a clear violation of the law. New developments this morning involving Elon Musk's push into artificial intelligence. Musk's XAI is said to be raising $20 billion, including $2 billion from NVIDIA, to finance AI chips for its Colossus 2 project. Sources telling us here at Bloomberg the deal, split between equity and debt, allows XAI to rent NVIDIA processors for 5 years. Cristiano Ronaldo has become football's first billionaire. According to the Bloomberg Billionaires Index, Ronaldo's net worth climbed to $1.4 billion. Ronaldo's wealth was boosted by a contract extension with Saudi Arabian team Al Nassr and endorsement deals with brands like Nike and Armani. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Fantastic write-up from the team about what makes this so original, that it's come from on-field earnings, that it's not all about endorsements, and a lot of it's come at the latter end of his career, being in Saudi Arabia. This sends a message for me. This is more about the riches of Saudi Arabia and the lack of income tax than it is about anything else.
And it raises a question about how other football clubs or soccer clubs compete with the fact that they have a checkbook that seems to be endless.
Equity futures. Let's get back to the market. Equity futures on the S&P, unless you're running a Saudi football club.
In which case?
Would like someone around their 40s who can't play football anymore. Might be available. Up next on the program, winners and losers in AI.
When you look at big tech, like tech that happens like this, there are a lot of losers, a lot of winners. In total, it's productive. There will be some real big companies, real big success. It will work, in spite of the fact that not everyone who invests in it is going to have a great investment return.
That conversation up next with Bloomberg's Matt Bloxham, live from New York City this morning. Good morning. Live from New York City, here's a sneak peek of the week ahead. It starts this afternoon, 1 p.m. Eastern Time, 10-year bond auction, $39 billion of debt coming to market. After that, an hour later, some Federal Reserve minutes. Look out for that. And then tomorrow, earnings from Delta, kicking off earnings season. Keenly watch, because that jobless claims number that's also due tomorrow probably won't be coming. Equity futures on the S&P 500 shaping up as follows. We are positive by 0.1% on the S&P, on the Nasdaq up by 0.15%, on the Russell up by 0.3%. Under surveillance this morning, winners and losers in AI.
When you look at big tech, like tech that happens like this, and you go look at cars, you look at television, you look at internet, big money's got spent. There are a lot of losers, a lot of winners. In total, it's productive. There will be some real big companies, real big success. It will work, in spite of the fact that not everyone who invests in it is going to have a great investment return.
So here's the latest deal this morning. Another massive AI spending deal may be in the works, this time involving Elon Musk's XAI and NVIDIA. Matt Bloxham of Bloomberg Intelligence joins us now for more. Matt, good morning. Just briefly explain the latest agreement and how NVIDIA fits in with all of this.
Yeah, so this is a $20 billion fundraise by XAI to essentially roll out their next big data center, which is called Colossus 2. And as part of that, NVIDIA looks like it could take about a $2 billion equity investment into that $20 billion, and that $20 billion is split between debt and equity. I think predominantly debt, our sources tell us. And then it will be essentially a special purpose vehicle. So rather than money going straight to XAI, there'll be a special purpose vehicle that buys the NVIDIA chips and then rents them over a 5-year period to XAI. And obviously it'll put them into that data center, and they'll be used, I guess, for a mixture of uses across both X and the AI side of that venture too, and possibly even, for use in Tesla capabilities too. So, lots of uses for that. Whether there's actually a kind of an end natural demand for that from kind of consumers and businesses is yet to be seen. To me, this feels like one of the more straightforward of these kind of slightly quirky deals we've been seeing in the last week or two. But inevitably, there is a bit of circularity there to this, and essentially this money will be finding its way back into NVIDIA through the purchase of their chips.
Matt, does this smell like the vendor financing of the late 90s? Is this any different?
Yeah, maybe the structures are a little bit different, but it does have a very familiar ring to it. And I think, clearly, we're all using AI to some degree in our daily lives and our business lives. But, I think the actual revenue that's being generated from this market today is incredibly small. And all of this money is going into all of these businesses on the hope and expectation that, the revenue coming in is going to, multiply a huge amounts. And I think if you look at the consumer market, that means that there needs probably to be a massive transformation in the advertising market. Also, all of that digital ad market money goes to Google and Meta, predominantly Google and Meta today, and that companies like OpenAI are going to have to get a big share of that, and we don't actually see that commercial model yet. And obviously we're going to have to see enterprises of all sizes and shapes spending huge amounts of recurring revenue with perhaps the likes of Oracle and Microsoft on AI-based technology, and we're not seeing that yet either. So all of this money is going into these businesses on a mid to long-term promise.
Matt Bloxham of Bloomberg Intelligence. Matt, thank you, sir. Appreciate it. This is snarky, forgive me, but why do buybacks anymore? Just invest in your customers. You get the stock move too.
Well, this is a great point. And for NVIDIA, that's what they're doing, and it works. My question is, who's potentially more at risk, right? NVIDIA from a company that might not be able to keep paying, given the fact that they're financing all of these companies to buy their goods, or the companies that are entering into very expensive agreements with NVIDIA because there seems to be no cost too high to pay to get access to the AI dream. And that, I think, is something to watch, those recurring revenues that are going to eat into margins. And we saw that a bit with Oracle.
Julian, good to have you with us still. For me, I try and make this really, really simple. They're being rewarded for this kind of behavior, for this kind of action. Is there any reason to believe they're going to be that someone's going to stop rewarding them anytime soon?
Look, there is always, and I go back to earlier this year, remember when DeepSeek came out, we were all absolutely flabbergasted, the end of the AI story, the CapEx build was going to stop. Well, it didn't. It accelerated. Now, will there come a time, the same way there came a time when you had, the rollback in the internet story in the early 2000s? There will, no question about it. But I go back to actually what the technology is, and we're still trying to figure out and understand what it exactly is. I know from our experience at Evercore ISI is that, number one, I am using AI more than I ever thought I would, not just 2 years ago when we launched coverage on it, but 6 months ago. And I will tell you, in the last 2 or 3 months alone, the quality of the AI, the ability for us to train our in-house AI has exploded. And I understand the efficiencies. Look, it is, again, going back to the late 1990s, there is always a sort of, an imagination that's expected, and there is absolutely going to be pockets of overinvestment, significant overinvestment. which is why, from our point of view, we want to stay with the names that have led the last couple of years and the names with the fortress balance sheets that will be able to take the inevitable volatility from the financing, how this all plays out.
So two things can be true at the same time, and we've seen this through history with a lot of bubbles, which is the technology can be very worthy and transformative, and valuations can be way too high, and people throw stupid money after stupid money. And I do wonder, you talk about fortress balance sheets, how different the past couple of months have been with the way that some of this is being financed, with some of the leasing contracts that have been entered into. How susceptible is the rally that we're seeing in AI stocks to earnings reports that don't show the same kind of expanding margins that we've become used to?
Well, when you think about the earnings season that's coming up, the bar is incredibly high now. A, given the fact that the last couple of quarters have been good. B, that we overshot the view on the downside of the economy in March and April. But to your point, Lisa, is that you've seen record debt issuance in the month of September, and a lot of it was to pay for AI capex, and the market rightly is sitting back and pausing and reevaluating what the equity of some of those companies is actually worth.
One thing that has been a huge supporter of this is that it has been done with cash. Have we moved to the point where more of it's being done with debt? I'm looking at, say, the investment-grade bond market, where you now have more tech-related bond sales in that space than even banks.
You have, and for us, and we think about risk as much as we think about reward. What's incredible about all of this is that credit default swap protection on investment-grade bonds is still near the lows. So frankly, this is an environment where actually, if you think about it as a portfolio manager, you can actually pay for some insurance that the market mood changes, whether it's in the equity markets because the VIX is so low, or the credit default markets because IG protection is so cheap, and still have your baseline investment, which frankly, in an environment like this, is likely to continue to outperform the indices.
Julian, what would the market reaction be, though, if one of these companies fails, given how entangled they are? What's that domino effect actually look like? Because of the fortress balance sheets of many of these companies, the Mag 7 obviously really are the ones that most come to mind, it's likely not going to have that type of contagion effect. But what it will do is what happens from time to time. At 26 times earnings on the S&P 500, it doesn't really matter how the bad news arrives. If it arrives, you're going to have a setback.
At some point, though, the ideas are good enough that they don't require vendor financing, surely. Why would they need the investment from companies like NVIDIA if these ideas were actually going to generate the income soon and quickly that people believe it will? It's a time sort of optionality to it. Again, when we launched 2 years ago on this, we had adoption curves that said corporate America would get to 25% adoption by the end of 2025. We're on track for that. But remember, that's only 25%. And given the build out and given the capex, you need to see continued acceleration. We think you get it. Got 30 seconds. Just before you go, people might believe your price target for next year is 9K. What is it on the S&P?
77.50.
Okay. It's bullish enough. Julian, thank you, sir. Julian Emanuel of Evercore, 77.50. Just to be very clear, in case you thought that 9K was the base case for Julian. Might become the base case, who knows? But there's a 30% chance from the team at Evercore that we achieve 9,000 points on the S&P 500 by year-end next year. Unreal. Coming up, Ian Lyngen of BMO looking ahead to Fed minutes from a divided Federal Reserve. Plus, Yahira has your morning movers. Confluent jumping on reports of another deal in the data space. That stock is up in the pre-market by close to 20%. From New York City, you're watching Bloomberg TV. Snapped a 7-day winning run on the S&P 500 in yesterday's session, bouncing back so far this morning. Equity futures shaping up as follows. Firmer by around about 0.1% on the Nasdaq, up by 0.2. Yesterday, the Nasdaq held back, reporting around Oracle. about the amount of their margins that are coming through from certain activities. We'll get into that story a little bit later this morning. I want to turn to the bond market and focus on the front end and the long end as well. The 2-year, the last time the Fed met, was at 350. Since then, we've been grinding higher, 356.16 so far this morning. Look out for the Fed minutes later on this afternoon. On 10s, we get some government debt a little bit later. 10-year bonds, $39 billion worth. Tomorrow, we get a 30-year issue. So that's going to be the main event later on this afternoon, just before we get those Fed minutes. 10s this morning at 410.36. And just to finish on gold, switch up the board. Let's get to gold. 4-day winning streak on the year so far, up by 54%. And earlier on this morning, through 4K for the first time ever. On the session, up by 1.4%. That's some of the cross-asset price action so far this morning. Let's get you some single names, some morning movers with more. Here's Yahira. Hey, Yahira.
Hi, John. We start on some possible deal news. Confluent shares are soaring nearly 20% in the pre-market as Reuters reports that it is exploring a sale after drawing takeover interest. It marks the latest data infrastructure company that's capturing investor attention due to its role in powering AI. Meanwhile, moving on to Lucid, those shares are lower after falling nearly 10% yesterday, down another 3.4% today after third quarter sales and production targets missed estimates. It comes after both Rivian and Tesla beat expectations as buyers rushed to grab those EV tax credits before they expired. But Lucid not grabbing the same tailwind. And we end on the latest parlor game on Wall Street. Guess which company the U.S. government will back next, and that is why you're seeing U.S. rare earths rising 5.4% after a 5-day winning streak. Meanwhile, critical metals soaring 15%, despite the White House saying yesterday that it was not considering a stake in this company. So surprising to see it surging today. John?
Hara, thank you. Thank you very much. We talked about this, didn't we, yesterday? This is going to be the game now. Who's next?
The market doesn't believe it. They're looking at all the companies that the U.S. government already took stakes in, and they're lining up, okay, what other critical minerals is this government after? And maybe we should go invest in those companies. Because likely, CEO Donald Trump or, the executive entrepreneur Donald Trump is going to go take a stake.
I think it's CIO. Donald Trump now, the asset management wing of the White House. That's the latest in the pre-market. On our radar this morning, President Donald Trump threatening to block back pay for some federal workers when the government reopens, saying some people don't deserve it. Democrats calling the move a clear violation of the law. Elsewhere, outgoing French Prime Minister Le Cornu is optimistic he can broker a deal to form a new government by tonight's deadline set by President Macron to break the political deadlock. And finally, Elon Musk's XAI is said to be raising up to $20 billion in new funding, with Nvidia as a key backer investing as much as $2 billion. Funds will be used to buy Nvidia's processors for XAI's Colossus 2 data center.
There's so many questions around this in terms of just what this means with vendor financing, as you put it, or circular types of financing structures. Interesting to see a greater portion of this coming from the debt markets also, not just equity. There are all sorts of questions about the cost of speed to market, speed to adoption, and whether the costs are adequately reflecting the potential risk and the potential opportunity. That's why I think Oracle's earnings yesterday, or the sort of warning report that was released by some media reports, signal that maybe these contracts are pretty expensive, and right now some of these big tech companies aren't able to overwhelm that with profits, which I think is really going to be key to watch in earnings reports.
And when you hear from NVIDIA's CIO, which we heard from our CFO last month, they were talking about the fact that they just want to be an accelerant when it comes to this. So they're willing to put their money into these companies. And we should talk about the other end of this. XAI, and Ed Ludlow has done some great reporting on this, desperately needs it. Elon Musk is burning through $1 billion a month when it comes to that company. So it comes at a time where they are desperately needing this cash if they want to be able to keep up with their peers.
We'll catch up with Ed later this morning on his latest reporting around XAI. Lisa mentioned Oracle. It came from The Information. Internal documents showing the fast-growing cloud business has had razor-thin gross profit margins in the past year or so, lower than what many equity analysts have estimated. That really helped snap that winning streak on the S&P 500 and brought back down the NVIDIA story, the Oracle story, and the broader story around the NASDAQ 100. We're bouncing back this morning, so back on trend, back to normal. Let's turn to the Federal Reserve. Traders looking ahead to the FOMC minutes due out at 2 p.m. Eastern Time. Lyngen of BMO writing 25 basis point cuts in October and December are already a foregone conclusion as long as there isn't a more dramatic downturn in risk assets. Ian joins us now for more. Ian, good morning, sir. It's good to see you.
Happy to be here.
When the Federal Reserve is in risk management mode, if they don't have the data, are they cutting or are they holding?
I think that they're going to continue to cut simply because the data shift that we saw over the course of the summer, including the benchmark revisions on the jobs front, suggests that we are cooling as an economy, and getting back to normal policy rates seems to make sense in that, with that backdrop.
I just wonder what you think of this dissonance between a labor market that seems to be cooling and GDP that seems to be going strong.
Well, as you've been discussing, the AI investment, CapEx, everything associated with that has not only been driving business spending, so keeping up the momentum of the real economy, but we are also seeing upside in equities, and that is fueling consumption because we know the top 10% account for 50% of consumption in the U.S., and I think that that has been a key driver. And when I make the observation about a potential downturn in risk assets, if we are going to slip into a recession at some point, it's probably going to come from a repricing of risk assets. But that certainly is not on no one's radar at this point.
I guess that I'm trying to understand whether it makes sense for the Fed to cut rates to protect jobs, given the fact that there is clearly a sluggishness to the labor market. You're seeing peripheral spending data showing a slowdown in September as well. I was looking at Citigroup data this morning. I just wonder if it makes sense to do that if you potentially pose the risk of turbocharging what some people are saying is bubblicious types of behavior in other sectors, AI being one of them.
Well, I think that that's what the Fed needs to decide over the course of the rest of the year, whether they're going to get back to 3% or 3.5, depending on what estimates you look at, or is there a risk that there's still more to be seen on the tariff side, even setting aside the bubble issue? I still think that there's tariff pass-through to inflation that has yet to be realized, and so we could see some sticky CPI prints when we finally get them, and that's the big unknown is when does the government start publishing data again?
So what are you tracking right now, given the fact that we're not really getting anything official from a lot of the sources?
So I think that we do have ADP and we have ISM and we have some of the private data, but at the end of the day, we're really just looking at the day count of the shutdown, because the longer it goes, the more uncertainty there'll be. And when the Fed meets later this month, the one piece of information that they will really have is whether or not the government has been reopened or if we're going to push that record-long 34-day shutdown window.
Do you guys have a base case of how long you think the government shutdown will last?
I think that it will get through the end of next week and at the earliest before we start to see any movement, because at that point people will stop getting paychecks. I assume that there'll be more rhetoric and more headlines out of Washington. But it's also a question of how the Democrats are going to be polling as a result of this going into what will be the run-up to the midterm and the politics around that, and that's always difficult to estimate.
So the Fed will be walking in potentially with that base case with a jobs report, but not inflation data. How concerning is that when the likes of Neil Kashkari are sounding alarms on too fast of interest rate cuts might be a problem in their stagflationary fears?
I do think that if they happen to have the jobs data in hand, that will be part of the story that they can justify cutting for, because a weaker job market is disinflationary on a forward basis, and that is, again, information. I do think it would be ideal if they had a full set of information, but at the end of the day, they're going to adjust to the reality as it comes in.
Ian, since the Fed last met mid-September, 2-year bond yields are slightly higher, 10-year bond yields are higher, the whole curve has shifted higher. What do you think that speaks to?
I think we're just in a range consolidation mode for the market. I think that we now know the direction of travel of rates. We have some uncertainty associated with the shutdown and what that means more than likely for the beginning of next year as opposed to the balance of this year. And we don't have enough convincing evidence to get back to 395 10-year yields, but also not to get back to 450. We're just in a range as we see how things play out.
Don't you think also that the rate story has stabilized because subsequently after the Fed meeting, we found out this Fed is far more divided than was actually revealed in that news conference with Chairman Powell? That maybe for a lot of people, they thought this was the start of a bigger rate cutting cycle, something down towards 3 and quickly. And what I've heard subsequently since is a bunch of Fed speakers with very different views about the future. Annmarie mentioned Neil Kashkari. There are some individuals that aren't ready to go again. Never mind go another 100. Isn't that part of this story as well? How big a feature is that?
Well, I think that what the futures market is telling us is we're comfortable with a glide path back to 3% sometime in the middle of next year. But as you point out, there are competing voices on the committee, and there do tend to be competing voices when we're at an inflection point, and we were at an inflection point. I think that Powell's comments in particular were an effort to ensure that there was as much flexibility as possible, and he didn't want to pre-commit to an October or a December move. So I think it's more of a business as usual than it is something particularly frightening.
This is sort of a perverse question, but it looks like right now in poly markets, there's only a 25% chance that the shutdown ends before October 15th. You said that this is the one piece of data that the Fed is going to have that's new, which is how long the shutdown's going on. Is that bond positive?
At the end of the day, I think it is, because it's more uncertainty, and we've spent a lot of the last 4 or 5 months with a trade war related uncertainty, as well as now shutdown related uncertainty, and that has led to a stalling out on the labor front. And until we have more clarity, I think people are going to be a lot more reluctant to hire, more reluctant to spend, and I think it's going to eventually be bond positive.
Ian, it's good to see you, as always. Thanks. Ian Lyngen there of BMO Capital Markets. As Stuart Kaiser said over the weekend over at Citi, no news has been good news for the equity market. It turns out no news is good news for the bond market too.
Yeah, I mean, honestly, as long as this goes on, you could make an argument. How reliable is the government to actually finance its debt? I mean, you could get into that question too, but if the slowdown continues, then people can just sort of bet in basic economics. Man, it's head-spinning stuff.
I think libertarians are happy with the idea that the government's shut down. You know, there's a part of society that are happy with that. They're unhappy when the planes get delayed.
Exactly.
And the airports get busy. And then their views on all of that start to turn.
And we had that yesterday. An advisory that air traffic control facilities in Philadelphia, Las Vegas, Nashville, Chicago, Houston, Boston were all short-staffed. It is starting to impact everyday people. And that was a pressure point in previous shutdowns with President Donald Trump in 2019, and it could be a pressure point again this time.
I'm really sorry. I have not met one person who said to me, I am so pleased the government shut down. And I think that this just reinforces that fact.
Spend some time with Republicans. They'll tell you exactly that.
Or Twitter.
So? Oh, absolutely, yes. People want a small government.
Well, small government's different than a totally dysfunctional
Sure. Understand
government.
that. But that's what this kind of speaks to. Some people are just okay with that. Move on with life. The world's still turning. The government's shut down.
As long as you can move on with life.
The sun still rises.
When the airport, when you face delays,
that's a problem.
Ideology goes out the window. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Teams from the United States, Qatar and Israel are gathering in Egypt for final negotiations to end the war in Gaza. The U.S. team includes U.S. Special Envoy Steve Witkoff and President Donald Trump's son-in-law, Jared Kushner. They'll be joined by an Israeli delegation led by Ron Dermer, as well as the Prime Minister of Qatar. India's Prime Minister Narendra Modi says he sent a warm birthday message to Vladimir Putin, praising the Russian leader's commitment to deepening ties. It comes just hours before UK Prime Minister Keir Starmer's arrival in Mumbai, providing an awkward start to a visit meant to focus on trade. And gold topped $4,000 an ounce for the first time. Concerns over the U.S. economy, government shutdown and fiscal stability adding to the rally. The precious metal has jumped more than 50% this year and is on pace for its best annual performance since the 1970s. That is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for the update. 2 news wheels. No Yankees update. What's going on this morning?
Well, I am the update. I'm wearing pinstripes.
We won. Actually, you've got a Yankees jersey under the blazer.
Yeah.
Okay.
There it is.
Nice. All right. Okay. When's the next game?
I got judged in the back.
All right. Okay.
When's the next game?
Tonight. So I might not be here tomorrow.
All right. You're taking tomorrow off?
Maybe.
Does management know that?
They do now.
Okay. Up next on the program, a slowing labour market.
Consumers continue to paint a picture of an ongoing slowing in the labor markets. If consumers tell you things are getting worse, I think it pays to believe them.
That conversation up next with Rob Sockin of Citi, live from New York City. You're watching Bloomberg TV. Live from New York City, welcome back to the program. Yesterday, snapping a 7-day winning run on the S&P 500. This morning, bouncing right back, up by 0.15 on the S&P, on the Nasdaq, up by 0.2. under surveillance this morning, a slowing labour market.
You still have to contend with this ongoing slowdown in the labor market. Consumers continue to paint a picture of an ongoing slowing in the labor markets. If consumers tell you things are getting worse, I think it pays to believe them. I think it's going to be increasingly obvious that the unemployment situation is getting worse and the Fed will have no choice but to continue to recalibrate policy.
So here's the latest this morning. Consumers becoming increasingly concerned about the labour market. A new Fed survey finding 41% of respondents expect the unemployment rate to rise. Rob Sockin of Citi writing the US labour market is challenging to read. Still, the broad universe of labour data does suggest that this is a much more vulnerable labour backdrop than we've seen in some time. Rob joins us now for more. Rob, good morning.
Morning.
Are you saying it's more than just a downshift in payrolls growth?
Well, that's the hard thing to judge right now, because on the one hand, we're getting some type of softening in labor demand. How big that is, we can debate. But at the same time, we have a softening of labor supply, given some of the tightening in immigration policy we've seen. So the break-even payrolls rate's going to fall, the one that balances supply and demand. But I think the rate that we're running at is below our estimate and, frankly, probably almost anyone's estimate of what that break-even rate should be. So it's a concerning picture. That being said, when you look at some of the other data that matches labor supply and labor demand, wage growth, the unemployment rate, also somewhat concerning on the unemployment side, but not raising red flags at the moment. So I think vulnerable is the best word to describe at this point, but too soon to say that we're going to downshift to a much weaker level.
So at the moment, we don't have the economic data. What we will have is the earnings. So we'll look to corporate America for a guide of what the consumer's doing. What we have seen is a trade down. This is what Savita Subramanian with Bank of America is worried about, that the trade down mantra could turn into buy less. Are you seeing any of that in data that you and the team track?
Yeah, and as you mentioned, it's a difficult situation at the moment because some of the key data that we track may not come out in coming weeks. But so far, we are seeing actually the consumer, at least in aggregate, hold up quite well. Now, when we've looked at this over the last few years, you've seen some of these narratives bubble up when you go across the income spectrum. So maybe on the lower or middle income side, you've seen some trading down, some more caution. Upper income side continues to spend quite strongly. That dynamic is likely continuing given the performance of equity markets and the positive wealth effect there. So it's really not that different of a picture than we've seen in the last few years. The difficult question is how much of the consumption resilience that we've seen this year is just front-loading activity before things get more expensive from the tariffs in coming months. And that's the hard thing to judge at the moment.
Would rate cuts help give people jobs, given the fact that this is a two-tiered economy, which is being driven by a technological advancement that is benefiting a relatively small group of workers at this point?
I think that's the key question, is how helpful would rate cuts be in that sense? That being said, I think it's clear that it'll help at least somewhat, particularly for maybe more interest rate sensitive sectors, interest rate sensitive businesses. Is it really going to move the needle very much if we're cutting at a gradual 25 basis point pace? Probably not, which is why it is difficult if things start to turn for the Fed to really get ahead of it and to really stop as that process is going. Another way of saying, if we are moving into a much weaker phase, the rate cuts can blunt some of it, but it can't really stop it, I think, at this stage.
Heading into the end of the month, when we get the next Fed meeting, Ian Lyngen was saying that we may just have one new data point, which is how long the government has shut down for. And that actually might be the most instrumental in deciding whether or not they're going to cut rates further. Have you run models to understand exactly how exponentially greater the ramifications are economically the longer that this shutdown goes on?
Yeah, this is a great question as well. And when I've looked at past shutdowns, in general, you find that there's a modest negative drag as it goes on for each week. But then most of that activity, or almost all of it, is made up once that shutdown ends. Now, this case might be a little bit different because the administration's talking about maybe not back paying some employees, maybe permanently laying off some furloughed workers. Then you would get some of that negative drag staying permanent. But it's very hard to know if you get some type of nonlinear effect the longer the shutdown goes through. The channel that I think that could happen from is if you start to get some secondary confidence effects from the shutdown, that people get very worried about how long this is going on, how dysfunctional it is, start to pull back in addition to the direct economic effects of the shutdown. But if it's just the actual shutdown itself, I think it's pretty linear as we go on. The more concerning thing, I think, is the data aspect, which is the longer this goes on, the more we're in the dark because the longer those major sources get delayed.
How difficult is it going to be for the Fed at the end of October?
it's going to be really challenging. And I think at least the positive thing here is if we listen to what the Fed had said at the last meeting, they were signaling they were going to cut twice more this year. I think the data picture looks broadly similar from what we're seeing from some of the private side data, even though that's kind of second best to the sort of the major official data. So I think the Fed would ideally like to have these major measures as it goes into that meeting. But without it, I think the risk management case says you should be cutting rates, as you said before, in that environment.
Circling back to your prior point about tariffs, right now companies are, according to you, absorbing 60 to 70% of the tariffs. When does that get cut in half? When do they start pushing more of that onto consumers?
Yeah, this has been one of the most challenging things for us to judge because we've been trying to map the effects of the tariffs. And, our view is that they dampen U.S. growth, they dampen global growth, but it's been a much slower process. And I think a big part of that is U.S. companies have been shouldering a lot more of the cost than expected, passing it on more gradually. As you mentioned, right now, we think it's about 60 to 70% on U.S. corporates. I think by when we get to the end of this year, early next year, it's probably going to be something more like 70% on the U.S. consumer, 20% on U.S. corporates, 10% on foreign exporters is our best guess. But timing that's been really challenging. Companies have been working through inventories to delay passing that on. And they've been using other strategies to kind of delay that pass through. But we do think more is coming.
I saw from the note from Nathan Sheets, you and the team, that you do think it's going to bite eventually, but you think the bite's going to be smaller.
Yeah.
And that the damage done for 26 will be marginal compared to what was expected back in April.
Yeah, and it's feeling a lot like the last few years where we had relatively bearish forecasts for the U.S. economy, the global economy, and we found ourselves remarkably surprised with the resilience and the flexibility that we saw there and ended up marking up our forecast significantly over those years and ended up growing in the global economy somewhere close to trend, U.S. economy above trend. And so now we're holding to that story that you get a bit of a slowdown, but it's mostly concentrated in the fourth quarter of this year, and it is smaller than we thought before. So it's becoming a tough call to hold on to given the resilience we've seen. But we think because of these factors, payback from the front loading of that spending from the tariffs and then eating into more consumer income from that rise in prices, that we'll get some type of a more material slowdown. But so far, we're not seeing it yet.
Rob, it's good to see you, as always. Thank you, sir. Robert Sockin there of Citi. It was certainly a sluggish summer. We're hoping for a bounce back in September, October and into year end. For August, this came from Redfin yesterday. Home buyers are cancelling deals at a record rate. Their data indicating roughly 56,000 US home purchase agreements were cancelled in August. That's equal to 15.1% of the homes that went under contract that month. That's the highest percentage in records dating back to 2017 for the month of August.
Yeah, and this really builds on what we're seeing, which is really weak spending when it comes to home improvement, really weak spending when it comes to forward-looking projects. How much is this idiosyncratic, and how much do we have the likes of Neil Dutta screaming, being like, no, this is the red flag, you've got to watch this, and a lot of people are.
See that in Citi's card data as well.
Exactly.
We're hoping for that bounce back. I hope we see it in the data we will get in the next few months, but at the moment we haven't got data, so that's not particularly helpful. Coming up next on the programme, we'll catch up with Tom Becker of BlackRock, Michael Townsend of Charles Schwab, Dominic Rizzo of T. Rowe Price and PIMCO's Rich Clarida. The second hour of Bloomberg Surveillance, just around the corner.
It's amazing how well the economy does, despite Washington.
The concerns about the loss of U.S. exceptionalism that were very dominant in the first quarter, they haven't been borne out in the data.
Even without a new data point, I think this conversation is going to intensify and complicate the ability for the Fed to justify any further movement.
There's this unfettered belief that the Fed can save every economic cycle, and that's where I'm just not for sure that occurs.
The unemployment situation is getting worse, and the Fed will have no choice but to continue to recalibrate policy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. You're watching Bloomberg Surveillance, and the second hour starts right now with your scores looking like this. Equity futures on the S&P 500 firmer by 0.2%, bouncing back after snapping a 7-day winning streak on the S&P. The main event so far this morning, not in the stock market, it's in the commodity market. Gold New all-time high. Record breaking through 4K for the first time ever, up 1% today, up 54% so far this year.
A real question, what's the signal from gold? What is gold telling us? Is it talking about the debasement of the dollar? Is it talking about just generally the central bank diversification that we've seen going on? Is it because there is a speculative fervor? Is it because everyone wants to be blinged out to start the end of the year cycle? I just really am looking at this and wondering what the correlation is to gold going up and stocks going up, and whether we can talk about how much people are losing faith in some of the traditional currencies at a time of quite a bit of dysfunction.
We had Goldman on the program earlier this week. I think we get into the speculative stage, away from the central bank diversification stage, which started maybe a couple of years ago because of the war in Russia and Ukraine. We're going somewhere else now, and it's more than just about the US dollar. Dollar's at a 2-month high. This week it's about the Japanese yen, it's about the euro. You've been talking about it. It's about fiat currency more generally that we're seeing this move in gold.
Absolutely. I think the latest catalyst a lot of people point to is the chaos in Washington, or not really chaos, just, we're chugging along because we're shut down. But the issue is global. Japan, Macronism failing again when it comes to France. There's a lot of political instability. You don't know where to turn, so why not go for the precious metal?
No instability in the equity market. Got another deal to talk about, potentially. Nvidia in the pre-market up by 0.7%. It's another deal. I'll keep this short and very simple. Nvidia is investing in another customer.
Yeah, Nvidia investing in Nvidia, because this is going to be money that is going to come back to Nvidia, which raises a couple of questions. Is this good for Nvidia? Shares going up and they get the revenue stream going forward. Is this good for XAI, given the fact that they are paying up for the privilege of accelerating their AI adoption? And it raises a larger question. Are people overly exuberant about the promise of the profitability of something that still is yet unproven, without necessarily accounting for the costs that some of them are promising to up front now?
And the fact that they're all just paying each other and then investing in each other. Morningstar analysts had this to say when we first had the first deal with OpenAI and Nvidia. If we get to a point a year from now where we had an AI bubble and it popped, this deal might be one of the early breadcrumbs. If things go bad, circular relationships might be at play.
Ed Ludlow helping to break this story. He'll bring you the details in the next hour, right here on Bloomberg Surveillance. Coming up this hour, Tom Becker of BlackRock with gold at record highs, Don Rizzo of T. Rowe Price as XAI gets a financial boost, and Richard Clarida of PIMCO with friction growing at the Federal Reserve. We begin this hour with stocks bouncing back and gold through 4K. Tom Becker of BlackRock sees rising risk. He writes the following: financial markets anticipated much of the recent upside of the macro data, and now the path looks choppier as we head into year end. Tom joins us now for more. Tom, good morning.
John.
You've taken down your equity exposure recently. Let's start there. Why have you been doing that?
So I think policy seems a little bit less supportive to us as we head into the end of the year. This summer, you had kind of policy upside surprise that you could position for, particularly after Liberation Day. Fed was looking to ease on any signs of labor market weakness. You had the Treasury kind of drawing down the TGA and kind of injecting liquidity into the banking system. As we head here into Q4, some of that's reversed. And so stocks have priced in a lot of the good news. We're heading into the Q3 earnings period, and I think they sort of navigated the tariff disruptions pretty well, how they kind of announced the Q2 earnings. So a little bit less upside surprise there. But I think there's this entanglement issue between the Treasury and the Fed that to us is drawing down liquidity here into Q4, which is a little challenging. So reserves for the banking system are coming down as the Fed's liabilities kind of shift down. Excess reserves are an asset to the banking system. That asset is kind of drawing down here as we head into Q4. We think that's going to be a little bit less supportive of liquidity. And the government shutdown, of course.
Well, you've also questioned the benefits of being in bonds in your previous appearances on this program too. So taking down the equity exposure, what are you taking up?
So we have the luxury of having lots of relative value exposures in some of the funds that we manage. And so by going long and short different countries in equities, we can kind of position for the outperformance or the underperformance. In bonds, the same thing. So we still like U.S. equities in the cross section. It's just directionally, we don't think that global equities are attractive as they used to be. So U.S., Japan look attractive. Some emerging markets look a little bit kind of, overpriced or kind of over-owned on the back of dollar weakness. On the bond side, we think relative value in going into some of these emerging markets like India, China, where inflation's low, we can get a real yield in those markets and sort of stay out of the developed markets where Issuance is high, inflation's still sticky, and so we're looking for those relative value opportunities.
What's so interesting is we had Julian Emanuel on earlier, who's talking about the potential for a bubble-like condition that pushes equities to 9,000, the S&P, by the end of next year. You're talking about a turn to nowhere. How much are these two stories at odds with one another?
I think people have extrapolated the really easy financial conditions we've had this summer and fall, and some of those we're seeing as turning to be a little bit less supportive. And so when the Fed and the Treasury are kind of like pedal to the metal, like it was this summer, I think that's a great supportive environment for risk assets. That's not what we see. The policies are a little bit more entangled here with the Scott Bessent kind of, rebuilding the TGA, which is a really big deal that people underappreciate. And I think that liquidity condition with kind of prices where they are and valuations where they are, positioning where it is, the S&P is just making new highs kind of week on week, and I think that's a little bit cause for concern. So just flatten out the portfolio.
I love this because so many people come on and they say, it's a bubble, it's going to explode, get on the train or get away because it's going to implode. And you're saying, actually, if you look at the monetary dynamics, it's neither. It's just that this has been the liquidity profile. Is that essentially how you're looking at it? This isn't necessarily an AI circular financing fueled bubble that's going to implode after exploding for the past couple of years, but rather just a technical aspect of the market that people have underappreciated until now.
The earnings have been great. So NVIDIA has all this money to kind of do these cross-listing deals because they're making so much money. So the U.S. is where the earnings have been globally. I don't want to downplay that. But in terms of just, the supportiveness for all financial assets, for gold, like you were talking about earlier, what are people looking to do? They're looking to kind of get some, keep purchasing power in some way. And I think the liquidity this summer was just, as much as you could ever hope for, with the earnings coming in much better than expected. And so a lot of that's in the price now. Right now, what's riskier? The equity markets in the U.S. or the bond markets in the U.S., given the underappreciation that you see in inflation? It's a tough question. I think the inflation profile, your last guest was talking about this, it just doesn't look good. Services ex shelter are just stuck at a level that's too high. The goods inflation is still trickling in. The Fed was hoping this was going to be a one-off, and then in 12 months they could say, okay, the price level shock is done. But instead you see goods trickling in slowly because companies are trying to kind of figure out how much the consumer can bear, how much they can kind of, how much they can weather in terms of their earnings. And I think the services side is really tricky with the AI. The build out of all of these data centers, you're not building enough nuclear power plants and grid to kind of support it. And so consumers are going to see that in their prices. Restaurants are going to see that in their costs, and they're going to pass it on to menus. And so this idea that it's going to be a one-off and done goods dynamic, I think there are other forces at play that maybe policymakers are just underappreciating.
This is what I wanted to talk to you about, because this is the first note where you was actually felt like a red alarm bell singing about inflation. It's not tariffs. It's actually electricity prices diverging around the world, but all going up.
Yeah.
How much is that going to be basically a backstop to all of this entire AI story? How does it continue if prices are surging and policymakers say, actually, our constituents are angry, we're going to have to press pause?
It's kind of Econ 101. You have demand going up and supply just stuck. And so you just can't build out the supply to kind of, the electrons just aren't there for all of this. And people are also installing heat pumps. So like the IRA pull forward, everyone got their electric cars, I hope, in the last few weeks because the credits expired. No, but really, the electrification of society is happening. And then we've layered on this huge kind of AI data center thing on top of it. And we just haven't done the build out of kind of the grid to support it. So I think there's this larger force at play. These don't happen all the time, so it's not like Fed policymakers can say, oh, the last time we had kind of an AI bubble or an AI build out, it was inflationary. And so I think they're just missing some of the services inflation that's kind of come from it.
The political blowback could be severe. The pursuit of 2% is looking less and less credible at the Federal Reserve. What are the consequences of that? Because it's not just the Federal Reserve. We've now got the BOJ in the mix as well.
Right.
New leadership in Japan and potentially a BOJ that says, you know what, we were going to hike, but now we're not going to hike. What does all this add up to?
I think it adds up to people looking for other ways to get exposure to kind of hedge their inflation risk. So fiat currency, the gold story, I think, is tied into, it's not just a U.S. story. It really is kind of all the fiat currencies. It is this fiscal dominance dynamic we've had post-pandemic. And so pedal to the metal fiscal If the bond market doesn't like it, then you shorten supply. You kind of like, hey, you only issue bills. You don't ram the long end of the market. But all of this is, we just have a lot of debt that we need to issue and a lot of investment we need to do. And so it's trying to find an equilibrium.
The release valve's the currency. If you're going to issue right at the front end, the Fed's going to look through a lot of this stuff. The release valve's the currency, which is why we're seeing a move in gold.
Yeah, the currency based on what? We're used to pricing things in dollar. Well, if you price it on gold, it's a very different story, and I think that's what an increasing number of people are looking at.
Tom, final note. Your commitment to Halloween, I respect it.
Yeah.
Okay.
Thanks,
Do you want to tell the audience what we're going as?
I think it's going to be Ted Lasso.
That's very cool.
Thank you.
You're going to share a picture next time you're on?
I might.
We'll make
see.
that happen for sure.
Thank you,
Tom, you're a good sport. It's good to see you.
Appreciate it.
Thank you, sir. Tom Becker there
Good.
at BlackRock. Thank you, sir. I'm not doing it. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. New developments this morning involving Elon Musk's push into artificial intelligence. Musk's xAI is said to be raising $20 billion, including $2 billion from NVIDIA, to finance AI chips for its Colossus 2 project. Sources telling us here at Bloomberg the deal, split between equity and debt, allows xAI to rent NVIDIA processors for 5 years. Salesforce won't pay a ransom demand from a hacker who claims to have stolen client data and threatens to publish it. The hacking group, known as Shiny Hunters, threatened to share information stolen during a security incident involving the third-party app SalesLoft Drift. And in sports, the New York Yankees live to see another day after winning Game 3 of the ALDS against the Toronto Blue Jays 9-6. Aaron Judge's 3-run homer tied the game at 6, and Jazz Chisholm Jr. hit a go-ahead solo shot. The Blue Jays now lead the best-of-5 series 2-1. Game 4 takes place in the Bronx tonight. That's your Bloomberg Brief. John.
Vonnie, thank you. You happy?
Staying alive.
There we
I'm
go.
so happy. It was so embarrassing how bad the Yankees were in Toronto. And also, hello to all of our Canadians that wake up early and watch us. I got so much hate mail
It's one way
on
to
Sunday.
upset half the audience,
Yes,
all right?
and look, I have my
Okay,
jersey.
all right.
I'm playing Wordle.
You're just ignoring all this.
Lisa's just a hater.
I did
She's one of
notice
those
on your phone a few
people.
times. Do you play Wordle during the show? It's just like what Janet Yellen did.
Just when, no, she was
She played Candy Crush.
She was Candy
And
Crush.
the spelling bee. I love the
You
spelling
believe
bee.
the Treasury
Wordle.
Secretary was playing Candy Crush when inflation was near double digits, but just in meetings playing Candy Crush?
Maybe it's a,
These bylaws can get boring.
Sure. Okay. Up next on the program, back pay under threat.
Is it the White House's position that furloughed workers should be paid for their back pay?
I would say it depends on who we're talking about.
Every single furloughed federal employee is entitled to back pay.
That conversation up next with Michael Townsend of Charles Schwab, live from New York City this morning. Good morning. Gold, it happened. 4K, through 4K, and not just a small break, a clean break of 4,000, up on the session by 1.3%, a 4-day winning run, taking this year's gain to 54% for gold for 2025, the biggest annual return potentially on record, going all the way back to the 1970s. Under surveillance this morning, we'll talk less about that and more about this. The government shutdown, back pay is under threat.
Is it the White House's position that furloughed workers should be paid for their back pay?
I would say it depends on who we're talking about. For the most part, we're going to take care of our people. There are some people that really don't deserve to be taken care of.
Every single furloughed federal employee is entitled to back pay. Period. Full stop. The law is clear.
So here's the latest this morning. President Donald Trump threatening to withhold back pay for some federal workers as the government shutdown enters its 8th day. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. Is the law clear?
So, John, it appears that the White House is taking aim at this 2019 law that was signed and enacted actually by President Trump after the last shutdown and is seen as the durable legal basis for federal workers to be compensated during times like these. But according to an OMB memo that's been drafted, it appears that they are arguing that this law has actually been misconstrued. They say that these back pay funds need to be appropriated explicitly and that they are not an automatic guarantee. Now, this is just a draft memo from the OMB, but if it is followed through on, it will no doubt face legal challenges. In fact, you even had House Speaker Mike Johnson yesterday confirm to reporters that Congress is looking into the legality of back pay as this issue moves forward. And no doubt adds to the escalation that we're seeing as President Trump yesterday also told reporters in the Oval Office that he will decide within the next 4 to 5 days whether or not to follow through on threats of permanent layoffs for federal workers, though declined to give us many specifics on exactly who that could be targeted against. I will say that we should keep in mind an estimated 750,000 federal workers are expected to be furloughed during the shutdown. And John, while the White House has taken some of these steps to definitely ramp up the pressure, we're actually seeing the White House try to mitigate some of the impacts as these discussions really start to drag on now into the second week. I mentioned yesterday on the program to pay very close attention to what happens with WIC, the Supplemental Nutrition Assistance Program for women and children. And yesterday, John, the White House confirmed it's going to use tariff revenue to supplement the program, try to downplay and mitigate those impacts as the shutdown goes forward.
Tyler Kendall with the latest in Washington. Tyler, thank you. To build on that conversation, joining us now is Michael Townsend of Charles Schwab. Michael, welcome to the program. So the president's words, I would say it depends on who we're talking about. For the most part, we're going to take care of our people. For some people, they really don't deserve to be taken care of. Now, Michael, for a long time, people have always said, take the president seriously, not literally. How seriously should we take that?
Well, I think that the president, we all know, the president says a lot of things that maybe go off message now and then. And I certainly think you saw some people on Capitol Hill on the Republican side a little bit frustrated with that because, you know, I'm not sure that helped their messaging. Democrats have done a pretty good job at staying on message, focusing on this health care issue. But I think when you're talking about not paying furloughed workers, I'm not sure that that's what the Republicans on the Hill were hoping to hear from the White House. So we'll see if he follows through on that. We also have, as Tyler just pointed out, we have threats to permanently lay off federal workers. I'm not sure that that's really helping the Republican messaging here.
Who is winning the messaging right now, Michael?
I think the Democrats are staying more united, and we certainly saw that in the last 24 hours with these couple of comments from the White House. But Democrats have been very focused on this health care issue. It's polling pretty well. I think they've done a good job at sticking with it. But I also think there's a reality here that, no one historically wins these fights. This is one of those things that a lot of people around the country, I think, roll their eyes at. Pay federal workers. Let's get the federal government open and functioning again. I can't get the Social Security Administration on the phone when I have a problem. That's the sort of thing that, I think who's winning the fight ultimately doesn't usually pay off very well in these disputes.
Americans roll their eyes until they're stuck at an airport, Michael. Is that going to be the biggest pressure point for this administration as it was for Trump in 2019?
I think that's definitely a big one. There's nothing more frustrating than long lines at the airport. And, we've seen some evidence that the lack of air traffic controllers at some airports is starting to impact flights, delay flights, close airports, and that's obviously going to be incredibly frustrating. I think the other big one is going to be the federal paydays that are coming up. We've got a payday coming up on October 10th for some federal workers, but the two big ones are October 15th, which is the military payday, and then October 16th, which is the bulk of federal workers. Once you start missing checks, I think the tone sort of changes, the attitude changes, because now you're sort of affecting people in a real world way. And that's, you're talking about a lot of federal workers potentially missing paychecks. So I think those are two big pain points, the federal paydays and the airline situation, the airport situation, that could maybe start to move this in a more productive direction in terms of the negotiations on Capitol Hill.
Michael, I'm just wondering going forward if we're still talking about the potential for widespread layoffs during the shutdown or if that's been taken kind of out of the picture.
Well, the president has again, threatened that, but he's really been threatening that since the start of the shutdown, and it hasn't happened yet. And I think there's some sense that there's a leverage point there for the White House to kind of keep that hanging out there as a threat to try to encourage Democrats to come to the table and have discussions. I certainly think there's some pressure on the Maryland and Virginia senators. Got a lot of federal workers in those states. But so far, I don't think that's been effective. And, the idea of just firing workers who had nothing to do with this entire dispute, just people trying to do their job, I'm not sure that's going to play well in the public. So I think the threats are there. We'll see whether there's actually a follow through.
Michael, I wonder if you can look at the parallel right now, which is the Supreme Court that is expected to rule at any time on the tariffs. And I wonder how much that's at play here. If that comes out at a time of a government shutdown, how much that reiterates the need to cut deficits should some of that funding not be coming in through the tariffs, at least not now in that lever.
Yeah, I think the tariff case is an absolutely fascinating one and obviously going to be huge. We're probably, 6 to 8 weeks away from getting a decision. You've got the arguments in early November, and then maybe early December would be a logical timeline for a decision. But boy, I agree, that would really kind of throw things into chaos. And that would also open up questions about whether there would be refunds for tariffs already paid. So I think that's a huge case. I'm not sure that that's going to have a huge direct tie to the shutdown, other than the fact that the president and others have said they're going to use tariff revenue for various purposes during the shutdown. You mentioned, I think Tyler mentioned earlier, the WIC program that the White House says that they're going to reroute some tariff revenue to support that program. So I absolutely think that case is an incredibly important one to watch, and we'll see how it plays out in a few weeks.
Michael, when it comes to service members getting paid, that's in a week. 2018-2019 shutdown lasted as long as it did because the Pentagon was funded. Is there any talk right now that even if we're still under shutdown, the Pentagon will be funded and men and women that serve this country will get paid?
Yeah, there has been some talk on Capitol Hill about, passing something that would specifically pay people who are serving right now in the military. That seems like a big lift. I mean, obviously, the House of Representatives is not even in session right now, and we're not sure exactly when they're going to come back. But I do think that's a big pain point. There's no question that that's going to be a little bit of a tipping moment here in this discussion. Once the military misses that paycheck, I think that's going to be very frustrating. You're talking about something in the order of 1.4 million people not getting a paycheck at that time. So I do think that's going to be a pain point. Whether they can pass legislation to specifically pay them is unclear. But I think you make a really important distinction from the last shutdown, which is that the Pentagon was funded at that time. That last shutdown in 2018, early 2019, was a partial shutdown because some agencies had already gotten their appropriation. So again, I think that's a big difference between this one and that previous one.
A key distinction. Michael, thank you, sir. Thank you very much. Michael Townsend there of Charles Schwab. Up next on the programme, we'll catch up with Dom Rizzo of T. Rowe Price with another AI spending deal in the works. Plus, Yahira has your morning movers. Lucid shares sinking after third quarter deliveries disappoint. That name is down more than 3%. Seven-day winning streak on the S&P 500 interrupted in yesterday's session. Back on course today, up by 0.1% on the S&P. On the Nasdaq, up by 0.1%. Also on the Russell, the small caps up by around about 0.25%. In the bond market, two events later on this afternoon. A 10-year government bond auction coming later, $39 billion worth tomorrow. $22 billion of 30-year bonds. That auction later is at 1 p.m. 1 hour later, Fed minutes. So all of that in focus for fixed income. 2s at 356. 10s at about 4.1% so far this morning. As we count you down to the opening bell, about 2 hours away, let's get you some morning movers. Here's Yahira with more. Hey, Yahira.
Hi, John. With spot gold now topping $4,000 an ounce, gold miners are riding the wave. We're seeing shares of Newmont and Barrick up while Equinox Gold is up 2.5%. Silver miners are also catching a bit here after that massive milestone. Meanwhile, moving on to Amazon, it announced this morning that it is rolling out pharmacy kiosks in offices of its One Medical Doctor service starting in December in Los Angeles, basically allowing patients to pick up their prescriptions right after their appointments. And that ease and the potential that Amazon expands the program is sending CVS shares slightly lower, 0.1%. And we end on Lucid. It had a plunge yesterday, 10%, down another 3% today after third quarter sales and production targets missed estimates. It comes after both Tesla and Rivian beat expectations as buyers rush to grab those EV tax credits ahead of their expiration. But Lucid not benefiting from that. John?
Yahara, thank you. Not just Lucid, of course. Yahara touched on the auto sector. More broadly, BMW. They had to cut their forecast too, citing China and tariff costs. German auto manufacturers not in a good place right now.
They're getting absolutely destroyed by China and the export machine that's there by tariffs in the United States, and they're squeezed in the middle without a cohesive policy about exactly how they're going to counter it.
7% move over in German trading. We're down by close to 8% on that stock. On our radar this morning, President Donald Trump threatening to withhold back pay for some furloughed federal workers. Democrats pointing to a law passed by Congress and signed by Trump during his first term, guaranteeing compensation for those workers. Turning to this story too, the price of gold soaring to $4,000 an ounce for the first time ever as concerns over the US economy continue to grow. Ray Dalio, the founder of Bridgewater Associates, saying gold is more of a safe haven than the dollar.
Gold is a very excellent diversifier of the portfolio. So if you were to look at just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold.
That was Ray Dalio sitting down with Lisa just yesterday. Lisa, your thoughts?
Well, it was interesting because Ken Griffin came out and said that actually gold would be a better haven than the dollar. And Ray Dalio said absolutely. He's had a 15% allocation to gold for a while. He said tactically he's increasing that significantly. And it has to do with what you were just talking about, the loss of faith in fiat currencies, given the fact that there is this monetization, this financialization of deficits around the world.
That's the latest on gold. We'll come back to that conversation. Really interesting the way things are changing. Not just for Ray Dalio, but for others too. Wanted to turn to Oracle, looking to bounce back after a report showing thin cloud computing profit margins. Oracle generating about $900 million from rentals of servers powered by NVIDIA chips, but recording a gross profit of just $125 million. That was enough to disrupt the story for Oracle and others too, just yesterday.
It highlights how concerned people are that maybe the profitability isn't going to be the money-making machine that we've seen over the past 3 years. The idea that they could generate $900 million in revenue, but at just $125 million of profit suggests they're paying high costs on a relative basis for the privilege of renting NVIDIA chips, for the privilege of having a relationship with OpenAI. Who else is doing this? Is this an Oracle problem, or is this a more global problem about expensive leases, expensive rental contracts, expensive debt that a lot of these companies are incurring because the race to adopt is more important than the price to adopt?
But guess what? Jensen Huang says nothing to see here. Don't worry. Last night, apparently he says Oracle will be wonderfully profitable when based off this report about the GPUs, and the margins are just not there. Talk about the circular economy of AI. You have Jensen Huang coming out and saying, oh, ignore this. It's going to be fine when it comes to AI. And Oracle is just going to do fine, even though right now this information report is saying things are not looking too bright.
Let's stay on top of tech. Elon Musk's XAI raising more financing than initially planned. Sources telling us here at Bloomberg the Musk company is tapping backers, including NVIDIA. Don Rizzo of T. Rowe Price manages a tech portfolio. He writes investor sentiment around AI remains firmly constructive. The sector is being driven by real fundamentals and not hype. Dom joins us now for more. Dom, welcome to the program. And I think you're absolutely right. There are real fundamentals here, and it's not just hype. But there are some echoes of what happened in the late 90s, specifically vendor financing. And I wonder how you're reflecting on that and making sure that you identify the pieces of this that feel a bit frothy and the pieces of this that are truly fundamental.
Of course. Well, first off, thanks for having me, guys. It's great to be back here. Look, if we take a step back, all this capital spending is really coming down to one thing. Is the scaling laws going to continue or not? If you throw 10x more compute at a problem, are you going to get 2x more intelligence? And right now, the answer seems to be yes. Now, if we take a step back, That's hard to kind of fathom as we go from a world where AI chips were $45 billion in 2023 to $500 billion in 2028 to upwards of $1 trillion in 2030. And that money needs to come from somewhere. I think it's going to come from a couple different sources. One is the vendor financing, like you mentioned, and you alluded to the 90s. Well, vendor financing actually started in 97 back in the day. And you look where else it could come from. It's going to come from private capital, right? So private credit, all these large private credit funds being raised. I think a lot of it's going to be employed in the data center. And then most importantly, this build out, and the biggest difference with the 90s is this build out's being funded by the most profitable companies in existence, and their core business is accelerating because of AI. So I think there's some similarities and some differences. Our job is to navigate it responsibly for our clients.
I think, Dom, that difference at the end is absolutely critical. And I want you to elaborate on it if you can. The strength of the balance sheets now compared to what things looked like then.
Well, let's take a look at Google, right? So Google obviously has a big portfolio, whether it's search, YouTube, their core chip business that they've used the TPUs to power their AI are fabulous. Now, they're going to take their CapEx up this year to $85 billion. I actually think there's potentially even upside to that. Despite that, they're still going to generate $75 billion of free cash flow, right? So there's a very big difference with the 90s. And then if you look at Microsoft, the amount of cash flow from operations they generate, Amazon, I mean, this is being funded by some of the most profitable companies in existence.
Dominic, would you rather own the equity or the debt, given the fact that they're probably going to be able to pay it back, but there are real questions about how much they can monetize it?
Well, Microsoft actually borrows cheaper than the U.S. government today, right? You guys were talking about the U.S. government that they're able to borrow cheaper than the U.S. government today. Look, I personally think the best place to be is AI chips, right? I think that there are periods of time where software has the power, and there's periods of time where hardware has the power. And I think we're in one of those points right now where hardware has the power. Names like NVIDIA, AMD, Broadcom are going to see huge incremental operating profit growth as we go from a $45 billion chip world to a $500 billion chip world. And I think that's what we saw with that OpenAI AMD deal the other day.
So if we consider that NVIDIA is going to be the winner, they're financing with pretty hefty costs other people to buy those chips. Are they going to be the losers from these deals? Are they going to be paying prices that are going to end up being punitive to their bottom line?
Well, first off, I think it's very hard to bet against Jensen. So let's see what ends up happening with these deals. If he thinks that Oracle is going to be profitable one day, I would imagine that they are going to be meaningfully profitable one day. We take that Oracle deal, for example. Of course that we're not anywhere close to long-term profitability. I think the number you said was $900 million in terms of revenue. I mean, their RPO was hundreds of billions of dollars, right? So we're still very, very early in this. In terms of, let's take that OpenAI deal as an example, right? With Jensen, I think that for that $100 billion of CapEx spend that he's going to end up putting out for them, they're going to get anywhere from $100 billion to $200 billion of net income, and also 10 to 15% of OpenAI, depending on the valuation that they end up investing. So I think the deals that they're writing right now seem to be quite value accretive for shareholders.
Dom, have you thought about the energy availability? Is it there to be able to really build out these data centers and these projects these companies are talking about?
You know, it's such a great question, and I'm so glad you asked it, because I actually think this is not going to be nearly the problem that people think it is, okay? So the general electricity in the United States is like 1.3 terawatts or so, and people are talking that we need anywhere from an additional 50 gigawatts to another 100 gigawatts to make this transition work, right? Well, first off, you build the energy grid not for peak, right? So most of the time, the energy grid's actually far underutilized, and you can do this thing called filling the shoulder, right? You can run these data centers when we're not running our air conditioning, and I actually think that's a really interesting proposition. There's a lot of capacity already in the grid, not to mention all the brownfield facilities, whether it's natural gas or coal, that could come back online. Over the long term, 2030 and beyond, of course, we have to figure out how to do other sorts of transitions from an energy perspective. But in the short to medium term, I actually think we're completely fine on energy. Now, I'll give you a quick stat. Each GPU consumes roughly the same amount of power as the average American house, right? So when we're talking about 1 million GPU clusters, we're talking about 1 million person cities. This is a big deal. We have to figure it out over the long term. But in the short term, I actually think we're okay.
Another policy issue I want to talk to you about, because I know you have a holding of ASML. They're actually falling today because of what's going on in terms of how much their sales are reliant on China and this committee in Washington, D.C. really going after that. Are you concerned with the geopolitical rhetoric and how hot it can get surrounding all of these companies that are reliant on doing business in Beijing?
Well, I think the geopolitical rhetoric kind of actually talks to how important these companies are, right? The linchpin status that these companies hold in our ecosystem today, right? I could make a super compelling case that ASML is one of the most important companies in the world with their extreme ultraviolet lithography technology. Now, if we look at the entire semi-capital equipment industry, roughly 20 to 30% of that is going to China today. That's actually picked up over the past few years. I think that's more of a mixed reason. We've had very weak memory spending in the US and in Korea, and I think that's going to come back. And I think a lot of this leading edge foundry spend is still on the come. So we'll see what ends up happening there. A lot of the China business is lagging edge, right? It's not leading edge. It's things, 14 nanometers and above, which is actually wildly profitable business for these semi-capital equipment companies. Very, very high incremental operating margins. Look, let's see what ends up happening with a lot of these companies. They've actually gone up a lot recently too. So there's always chances for tactical pullbacks, so we're always flexible in our framework. But over the long term, we're kind of thinking about these companies seeing increasing capital intensity at the semi-manufacturing layer. These companies will collect economic rents, and ASML with their prime position in extreme ultraviolet lithography remains one of the best positions.
Don, just before you go, isn't this what the market is asking for? I'm always interested in how financial markets condition the C-suite. And you mentioned Microsoft borrowing costs. That's the market telling Microsoft to lever up, borrow from the debt market. And what I'm seeing this morning, I've seen repeatedly over the last week, and this is slightly snarky, but take it somewhat seriously. The market's telling these companies not to bother with buybacks, just to buy your customers, just to invest in them, and you'll get rewarded even more in the equity market. So, Dom, don't you think we're just going to see even more of this in the next few months, just until the market says no more?
Look, all cycles are reflexive, right? Price action ends up creating reality, and reality ends up creating price action. And if we end up going forward, look, I think AI has the potential to be the biggest productivity enhancer for the global economy since electricity. Electricity added roughly 1% to GDP for every year for 32 years. People are going to want to pull that spending in. What happens with productivity cycles? Speculative bubbles. Our job is to use our investment framework to navigate those speculative bubbles responsibly for our clients. And we do that by trying to capture the upside and blunt the downside. So I think it's a great point you raise.
Hey, Dom, it's good to catch up with you. Fantastic conversation. Dom Rizzo there of T. Rowe Price. That reflexive nature is going to be what causes this massive misallocation of resources. At what point, I don't know. And in the minds of a lot of people that come on this program, they seem to be pointing out that this is just the beginning. Dom mentioned there 97. Like, this might just be the beginning of that feature of all of this.
Because to your point, the market's saying, go for it. And guess what? We endorse it. And at a certain point, you start to have to watch how much leverage is getting built in and how realistic some of these deals look. But it doesn't seem like we're there yet.
Nasdaq futures up again this morning by 0.1%. Similar move on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says he expects the US and Canada to come to an agreement, but remain vague about how and when it might be achieved. Canadian Prime Minister Mark Carney told Trump that Canada is the largest foreign investor in the United States and suggested the pace of investment may accelerate if they get the agreement they expect to get. Meta and Apple reportedly nearing settlements with the EU on two major antitrust cases. The Financial Times reports the companies are in the final stages of a deal with regulators to change a range of business practices. Meta is expected to modify its controversial pay or consent data tracking model, while Apple is moving to comply by altering its App Store policies. Thousands of flights have been delayed due to air traffic control staffing shortages during the 8-day, so far, government shutdown. Air traffic controllers are considered essential workers and are exempt from being furloughed, but will continue to work without pay. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. Up next on the programme, gold standard data.
I do think that the U.S. government data have been and remain and will continue to remain the gold standard and the best in the world.
We'd just like to see some of it. Richard Clarida of PIMCO joins us next. Stocks are positive by 0.2%, bouncing back once again this morning on the S&P 500. Similar story across the board on the Nasdaq, up by 0.2, on the Russell 2000. Small caps up by 0.4. Under surveillance this morning, gold standard data.
My view is that monetary policy should be forward-looking. Policy works in the economy with lags. One reason for why my dot for 2025 sticks out so much from everyone else's is because I'm more sanguine on the inflation outlook. I do think that the U.S. government data have been and remain and will continue to remain the gold standard and the best in the world.
So here's the latest this morning. Investors looking for clues from the Federal Reserve meeting minutes with official government data now on hold. The former Fed Vice Chair, Richard Clarida, now with PIMCO, writing, in the absence of official data, private sector releases provided the only available signals, imperfect but informative, adding to a broader array of data points consistent with a slowing of the U.S. labour market. Richard joins us now for more. Rich, good to see you.
As always, glad to be here.
Thanks for dropping by. Critical moment for the Federal Reserve. They've called it a risk management decision back at the end of September. What do you think the decision will look like at the end of this month?
Well, I think they cut again, in part because they may not get any more official data between now and then, and the high-frequency data has been consistent with a slowing labor market. So we are expecting a cut at the end of the month.
You and the team have talked about the tension across traditional indicators. Can you build on some of that? Where are you seeing tension right now?
Well, at least through the summer, Powell and the committee seem to talk about this curious balance in the labor market, low payroll gains, but also lower supply of labor because of immigration. And I think the balance tipped with the big revisions that we got in early September, 900,000 jobs being revised away, and also some of the official prints. So I think the combination of that did tilt the balance towards the risk management cut.
Which raises this question of the risk management on the labor market. Is that going to hamper the risk management when it comes to the inflation side of things? Do you think that the Fed and potentially the markets are underestimating how much that piece is going to roar back in the beginning of next year?
I think it's a great point because there are two sides to risk management, and the other piece is the inflation risk management. And the reality is core inflation now is about where it was 18 months ago. It's a little bit below 3%. That's better than, several years ago. But I think that is a risk management consideration. And, Lisa, you do hear that from some Fed officials in their commentary, the more hawkish members of the committee, reminding that there's also risk to inflation.
Do you think that we are high enough above the neutral rate to have risk management cuts that do not materially affect the inflation backdrop? Because that is the argument that some might make when they weigh the labor market more than the inflation side.
Well, first and foremost, we don't observe the neutral rate. We all try to guess a little bit about what it is. I do agree with the committee that rates are currently at least somewhat restrictive. But I think once you start talking about another 2 or 3 cuts from here, you'll probably get folks on the committee with differing views on that. And I think also the neutral rate also depends on broader financial conditions, and those are being supported by enthusiasm about AI. So a lot of juggling that the Fed needs to do right now.
Besides not having the data, how does the government shutdown impact the Federal Reserve? Because you were there for the longest government shutdown in 2018, 2019, of 35 days. Typically
not so much. The most relevant part, indeed, Annmarie, is the data. If you're not getting the data, you're feeling a little bit incomplete. Although there are alternative sources. Usually, government shutdowns are really more of a political story than an economic story. Workers get the back pay eventually, and so it's really more about the data than I think anything else.
Workers usually get the back pay. President Trump is using this as a threat. Is this time different?
It could be different. I'm not up on the statute about what is relevant or not, but in the past, the episodes have not been that disruptive macroeconomically because of the back pay.
When do valuations start to matter in financial markets? This came from the Bank of England. Mike McKee's going to be talking about this later. The Bank of England say equity valuations appear stretched, notably for AI firms. The chairman of the Fed was asked about valuations recently, and he gave a throwaway comment about valuations being somewhat high. Nothing too much. But when do they start to become a factor for you?
I guess the quip would be something along the lines of, valuations don't matter till they do. We don't know what that is. Now, the reality is there's a lot for the U.S. equity market to like. The U.S. is a rapidly growing economy compared to the rest of the G7, strong productivity growth, innovation. So there's always a balancing act, as there was in the 90s earlier in my career, about fundamentals versus, irrational exuberance. Yeah.
If you were still on the Fed, would you be concerned about valuations currently?
It would be an input right now, but in particular, what we're seeing in the equity markets is a lot different than in the 90s. These are real companies with real cash flows and real business models. It's much less of the sort of pets.com euphoria that we saw then. So it would be on my radar screen, but it would not be first order right now.
Doesn't it raise a question of exactly the transmission mechanism of lowering rates right now, and exactly how much that actually can support job growth, given the fact that there is completely open capital markets?
Or to get back to the earlier comment, if it would be on my radar screen, it would be more along the lines of perhaps rates are not all that restrictive, given the elevated valuations and wealth effect in the economy. So that's another input to that.
I think that's the concern people have, Rich, and I'd love your input on this.
Yeah.
The risk that the Fed is anchoring themselves to one particular data point, and that's payrolls growth.
Yeah.
When you look across the broader economy, GDP's holding up quite well.
Very
Financial
well.
conditions are super loose. Does that have to be a consideration on the committee month end? Do they have to start thinking about maybe we're anchoring ourselves to the wrong data point here?
I think it's a consideration, but again, I just go by what they say, not what I think they should do. And they, or at least the chair, seems to have made the decision that they're in risk management mode. He said many times for more than a year they do not want to see additional slowing in the labor market. And so I think at least for the rest of this year, that is going to be driving the decision. But you are right. The only way to square the GDP data, GDP now is somewhere in the threes for the third quarter. And the labor market data is very strong productivity.
This is the dilemma for the Federal Reserve month end. Rich, it's good to see you, as always.
Thank you.
Richard Clarida there of PIMCO on a difficult decision for the Federal Reserve. More difficult than I think others have suggested, given what's happening elsewhere beyond just the step down in payrolls. And I know I sound like a broken record, but the Chairman Powell we've heard from recently was different to the Chairman Powell we heard at the end of July with regards to the labour market.
Talking about the unemployment rate versus the actual absolute number of jobs being created, this is a difficult moment. I mean, I was speaking with Ray Dalio yesterday, and I was asked him, do you think that it is appropriate for the Fed to cut rates? And I expected him to say, absolutely not. Look at the debasement of the dollar. Look at what's going on with gold. He said it's tricky because this is a bifurcated economy and the lower income sphere is more leveraged to that short end rate. So it is just a very complicated moment.
Given his positioning in gold, I imagine he'd like them to cut at the end of this.
Well, that would happen. Exactly.
15%.
Maybe so. But, for larger picture stories, maybe not so much.
Coming up on the programme, Ross Mayfield of Baird, David Deckelbaum of TD Cowen, Greg Daco of EY, Ella Hoxha of BNY. The third hour of Bloomberg Surveillance. Up next.
The market seems to be in new economy dynamics, right? At least for AI.
We are still in the earlier part of the investment cycle. Call it over a quarter of the economic growth is coming from this AI supercycle.
At this point, I think we're getting into bubble territory.
Whenever demand is very strong and has been for a number of years, one has to always have an eye towards the next downturn.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Looking at all-time highs potentially at the opening bell, up 0.2% on the S&P, on the Nasdaq up by 0.2, also on the Russell up by 0.5. Check out this name in the pre-market, Nvidia inching higher through most of this morning, up again by 0.6%, as we break some news that they might be investing in XAI.
Yeah, and this really has raised questions. We've been discussing it throughout the morning that maybe NVIDIA is lending money and giving money to other companies to buy NVIDIA chips. And does this feel reminiscent of some of the things that we saw back in the 1990s, late 1990s, heading into the dot-com bubble and then the bust? Question is, let's say it is. Does that mean you buy more? Or does it mean that you flee? Because ultimately, if it's a bubble, to the point that Julian Emanuel was making, doesn't it have a lot more to blow, considering the fact that we've seen a lot of bubbles and they've gotten a lot bigger than this one?
Market conditions are incentivizing more of the same behavior. It's going to take a very disciplined C-suite to resist some of this. We mentioned this with T. Rowe Price just moments ago. Look at the borrowing costs of Microsoft. That's the debt market telling these big tech players your balance sheets are strong. Do more. Borrow some money. Go and invest even more. And also, based on the deals, and I know I've said I've been snarky about this a few times, but I am kind of serious. This equity market's telling these major tech players, don't just do buybacks. Use that money now to invest in some of your customers, these companies that are going to spend money with you, because the stock market's going to reward that too.
And honestly, I can actually understand the rationale for that, because if this is a race to see who adopts more quickly and who gets a bigger footprint more quickly, well, then that might make sense financially. The question is, when you're dealing with such big numbers, how do you even get your head around what makes sense and what doesn't? And there's a lot of finger to the wind, pay any price at all to get in versus some sort of prudent analysis, hopes and dreams, make maybe the new technology. But markets maybe can get a little bit more hopey and dreamy than they can rational.
That's when things can get messy.
Yes.
Let's put it that way.
Thank you. That's better.
What we're describing is
English.
what can make this really messy and lead to that massive misallocation of resources, because you're being incentivized to do things. And when you start to get that reflexivity kick in, and maybe this is just the beginning, and some people on the show, we heard that from Wells Fargo yesterday, who believe it's just the beginning. Once you start to get that leverage come in, then it's 97, 98, 99.
What I want to understand is what the contracts are that they have already entered into, how much the lease payments are, how expensive they are, what the profitability is, and then to understand just how much debt is embedded in all of these companies as they invest in one another, because right now, I don't know that we've got a full handle on that.
Stock is up by 0.6% at the pre-market. Check out the week ahead. We're meant to get some economic data. We're looking for jobless claims tomorrow morning, 8:30 Eastern time. Probably won't get it because of the government shutdown. The hope is we'll hit those traditional pressure points, and ultimately Congress, the White House, will have to come and make a deal. How close are we to that?
Well, we're not close there just yet. We are close to the pressure points, but no one's blinking. So the end of this week, federal workers will likely not get their paychecks. Then next week, it'll be the more than 1 million active duty servicemen and women that potentially will go without pay. That is a huge deal, and that is not going to go well with the American public. And then there's a third, which I think is definitely the biggest pressure point, when people get delays. And yesterday was a big one. Look at all these airports: Philadelphia, Las Vegas, Nashville, Chicago, Houston, Boston, all short-staffed because of the government shutdown.
It's a good job it's October and not late November.
True.
Different conversation. Very quickly. Equity futures on the S&P 500 firmer here by 0.2%. Coming up this hour, we'll catch up with Ross Mayfield of Baird as Nvidia is investing in another customer. David Deckelbaum of TD Cowen with investors betting on Trump's next investment. And Greg Daco of EY as he's raising his bets on rate cuts. We begin this hour with stocks inching higher. Ross Mayfield of Baird warning we may be in for a healthy pullback. He writes the following: Q4 could be choppier than usual, but remain bullish on stocks for 26. A correction here would be healthy against the broader backdrop. Ross joins us now for more. Ross, welcome to the show, sir. I think a lot of people would welcome a pullback because they want to buy it. Ross, what would bring it about?
Yeah, absolutely. I would think it would be viable as well. I mean, we've seen the things that turn a bull market into a bubble, right? It's usually when sentiment gets really unchecked. You look at some of the classic like Schiller lists of what marks a bubble, and it's all about FOMO and chasing investments and sentiment. And these corrections along the way kind of reset sentiment, let fundamentals keep up with price. And I think that's really healthy. What could cause it? I think right now the most obvious thing is if this shutdown goes longer than people anticipated, if there are consequences that haven't been the case with past shutdowns, right? Some of these furloughed workers not getting paid, as you mentioned, delays really ramping up as we head into a holiday season. So that could be the obvious thing if we start to see a real trickle through to the economic data that we might eventually get. But as of right now, it's only the questioning of the AI trade, and if we have another DeepSeek moment, that I think could really put a chink in this thing.
We won't be getting data potentially tomorrow morning. We will be getting earnings from corporate America, including from Delta Airlines. Ross, what's your approach going to be to earnings season?
Well, I still, we're talking so much about AI now, and the market is melting up. So all of the kind of headwinds that we faced have gone away. I'm still curious how companies that deal with tariffs and imports are handling this. Yesterday, we got news about more tariffs on trucks and big trucks, and so I don't think that investors should let this headwind kind of slip to the back burner. These tariffs are still massive. We'll find out obviously if they're legal soon, but I think the administration has plenty of ways to put them back on if they're ruled illegal. So I think that how companies are managing input costs, obviously the S&P profit margins are kind of near record highs. A lot of that has to do with big tech. How's the average company dealing with tariffs? Are they passing it along to their consumer at a time when that might not be so well received?
Ross, where is this most potentially mispriced? Is it in inflation expectations or is it in growth expectations?
That's a great question. Probably inflation expectations at this point. You look at like a 5-year break even and it's, a little north of 2. I think that we're in an environment that's just very, very different from the 2010s post GFC kind of you're desperate for economic growth or growth of any kind. Today, we have plenty of growth. We have deglobalization across the board. We have all of these other countries, stimulating or pushing fiscal levers in a way that they haven't before. So I think a second wave of inflation, not back up to 9, 10%, but that kind of stickiness around 3, maybe even 3.5%, 4% is something that could put a real thorn in the Fed's side. So I think inflation expectations don't need to be blown out, but I think we're just dealing with a different regime, and maybe there's a little bit of anchoring to the past decade that I think needs to be tossed away.
Why aren't you seeing this in the break-even rates? Why aren't you seeing this in long-term bond yields? Why aren't you seeing this in some of the other market-based indicators at a time when so many people come on this show and they say the same thing that you just have, and yet we don't see it reflected at all?
I think there's enough worries about growth here. I mean, you look at the labor market, it's clearly softened. We don't have the data right now, but we could have another negative payrolls print. I think there's just enough concern about economic growth to keep long yields, break evens anchored, because there's still those kind of higher than normal odds that we go into a recession sometime in the next 24 months. Look at the jobs numbers, look at some of the other economic data, look at where interest rates are still, theoretically in restrictive territory. And then there's, potential kind of idiosyncratic tailwinds or headwinds out there. So I think there's just enough worries about growth, particularly outside of the kind of AI bubble, AI trade, that is keeping a cap on those long yields and break-even rates. But, eventually one of those things has to win out.
Ross, do you think that's why we have gold topping 4,000?
Yes. I mean, you've got gold in an incredible bull market, despite the fact that real yields are pretty high relative to recent history. I mean, that shouldn't be a good, and nominal growth doing well, that shouldn't be a good cocktail for gold. And instead, we have gold as one of the best performing assets in the world. I think it has a lot to do with concerns about the kind of fiscal dominance narrative, what's happening at the Fed, is politicization of the Fed. The debt narrative, obviously, we had these big tax cuts. We know what the potential for that is on the deficit long term. So, yeah, I think the geopolitical turbulence around the world, paired with some of the fiscal narratives, both in the U.S. and abroad, you look at France, you look at Japan, I think that's plenty for gold. And we know it's just supply demand in the end. And we know that other central banks who are a little worried about the U.S. position in the world and the use of the dollar as a kind of an economic weapon are loading up on gold as well. So there's clearly demand there, outpacing supply.
If you think there's a correction to be coming, at least in the equity market, do you see gold going even higher?
It's a good question, because typical correlations might say yes, right? You kind of rush to those safe haven assets in times of equity market stress, but that correlation is broken down. Again, real yields higher, gold higher, stocks higher. This is kind of a new regime, and I think the gold trade is more linked to some of these more structural issues in the global economy. Again, fiscal dominance, debt and deficits. So I think gold could correct here. I think positioning is probably getting to a point where it's offsides. I know anecdotally sentiment is quite bullish on gold, but I do think it's operating a bit, kind of not in lockstep with equity. So we could get an equity correction and gold could go down with it. We could also get an equity correction and see gold move higher. I think it's that correlation is closer to 0 than it is to, -1.
It's up this morning by 1.5%. Ross, thank you, sir. Ross Mayfield there of Baird. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Vonnie for more. Hey, Vonnie.
Hey, John, thank you. The Bank of England says steep AI valuations and challenges to the Federal Reserve's independence are raising risks of a, quote, sharp market correction. In its quarterly financial update, the UK Central Bank finds tech companies focused on AI are particularly vulnerable, especially if expectations around AI become less positive. Tesla shares trading slightly lower in the pre-market, continuing yesterday's sell-off. The EV maker introduced cheaper versions of its top-selling models in a bid to counteract the loss of US incentives for electric cars. The new standard versions of the Model 3 sedan and Model Y are priced at under $40,000 with less battery range and stripped features. Hockey is back after a 3-game slate on the NHL's opening night. The defending champion Florida Panthers beat the Chicago Blackhawks on home ice. The Avalanche beat the LA Kings 4-1 on the road, and the Pittsburgh Penguins shut out the New York Rangers and their former head coach Mike Sullivan at Madison Square Garden 3-0. That is your Bloomberg Brief, John.
Bonnie, thank you. Appreciate it. Up next on the programme, the Morning Calls Plus, David Deckelbaum of TD Cowen with investors betting on Trump's next big investment. We'll get to that story up next.
Each bubble was larger than the last. If you're not concerned about the potential knock-on effects of all this kind of cross-shareholder relationship, you're probably not paying sufficient attention. As difficult as it is, and it is difficult to invest in these valuations, we think that you need to stay invested.
Stick with it. Julian Emanuel of Evercore telling you to stick with this rally. Equity futures right now in the S&P adding some weight to the recent rally and taking back some of the losses of yesterday. We're up by 0.1% on the S&P. On the Nasdaq, up by 0.04. Some outperformance today on the small caps. The Russell up by 0.3. Let's get to your morning calls. That's the price action. Here's some single names. First up, Stifel raising its price target on Tesla to 483, citing advancements in its robotaxi network. Your second call from HSBC, downgrading Intel to reduce, saying its deal-driven rally is, quote, overdone. And finally, Wells Fargo raising its price target on Dow to 180, expecting strong free cash flow and capital return. Staying on Wall Street, Trilogy Metals continuing to rally after President Trump's administration announced a 10% government stake in the company. The move adding to a series of investments made by the government so far this year. Bloomberg's Michael Shepard joins us now for more. Shep, welcome to the show. It's another one, and the list is growing. Mike, what's the conversation sound like in Washington around what's starting to look more and more like central planning and state capitalism?
Well, central planning from one point of view, but from the Trump administration's point of view, they see an urgent problem that needs to be addressed. And that is the imbalance between what the U.S. brings in terms of rare earths and critical minerals for industries ranging from autos to consumer electronics and what is produced here. And the big concern is that so much of that, John, comes from China, which is our chief geopolitical rival and strategic and economic competitor, also locked in trade talks with the Trump administration. And the advantage that China has in rare earths has given them leverage in these trade negotiations. And what the Trump administration is really pushing to do with these investments, and the Trilogy move followed a direct interest that was announced in Lithium Americas. And remember, lithium is critical to electric vehicle batteries. And then the Pentagon taking a $400 million stake in MP Materials, and that's to support a rare earths plant. So they are trying to pick up the pace in addressing a problem that prior administrations have recognized for a long time, but haven't taken on with the same sense of urgency.
So, Shep, you can open the door for these companies just by loosening regulations. The financial markets are wide open. These companies can raise money if they need to. Shep, I'm sympathetic with the objectives. Most logical people, just thinking about this logically, would be, these are things that we need here domestically. Got all of that, no argument at all. It's more about the process and the approach, Shep, that's got people's attention. Why is this the optimal approach?
Well, they are arguing that they need to move fast, and these companies need even more financial incentive, not just the promise of loosening regulations that really have hamstrung some of these projects. And those included regulatory restrictions dating back to the Biden administration and beforehand. Yesterday, as part of the Trilogy deal, they also announced a move to clear permitting to allow a road to be built to a key project in Alaska that Trilogy is seeking to pursue. So the administration is trying to tackle this problem, John, on a lot of different fronts. But one thing that they do see is a sense of urgency, and it is a sense of urgency that they are bringing in, perhaps from that Wall Street perspective. A lot of this is being driven by Trump, the art of the deal, Howard Lutnick at Commerce, and Steve Feinberg over at the Pentagon, who've all identified critical minerals as something that needs to be addressed right away, and they are looking for the tools to address it quickly.
Shep, appreciate the update. Michael Shepard down in Washington, D.C. The analyst David Deckelbaum of TD Cowen covers some of the companies the Trump administration has invested in and has this to say: investors have to ask, who's next? Stocks are moving fantastically on this news, no matter what the actual details are. David joins us now for more. David, good morning.
Good morning. Thanks for having me.
Your job has changed.
It has changed indeed, sure.
The White House is now picking the winners.
Yep.
How does that change your approach?
Similar to my comments before, it was interesting. In your prior conversation, you were talking about, what's the process behind all of this and what's the intention. And I think really it's for the administration, one, to some extent, to make an investment on behalf of taxpayers, but also I think to raise the profile for the general investing public that these companies are a priority and that these industries are a priority. And now everyone obviously has their hands out, and you've seen companies openly talking about and disclosing we're having conversations with the USDO, Department of War, we're having conversations with the Pentagon. And I think it just sets the stage for what should be triggering a multi-year investment process in the broader material sector.
Theoretically, a lot of people could get behind this, and it seems like it does make sense, at least according to both sides of the aisle and what they've put out there. Is the administration picking the right names?
So I would say with their first investment, I'm not going to speak on Intel. So let's look at MP Materials, right? They're the largest rare earth miner in the Western Hemisphere. I think that was a very logical chosen champion for this administration to get behind because it unlocks multiple parts of the supply chain for rare earths and ultimately magnets. You also saw a follow-up deal with Apple right on the heels of that. So I think all of these things were connected. In the context with Lithium Americas, the government was already involved with a substantial loan that the DOE had approved under the Biden administration under the ATVM loan program, which sought to really propel the lithium supply chain in North America, largely around the proliferation of electric vehicles. We've walked back a lot of the EV tax credits and incentives there, but I think there was still partly a recognition on the part of the government that we're already in bed with this company from a loan process. Let's sort of rework some of the terms. Did it actually improve the outlook for Lithium Americas? I would argue perhaps no. It really just diluted really diluted the equity holder at that point. But it does obviously raise the profile, and the stock moved up well over 100%, without really caring what the details were.
So can you just basically look at whoever the U.S. has given a loan to and say that probably will be equitized?
Sure, you can certainly build. I mean, you've seen a lot of names already moving in anticipation that they're going to receive funding in some form. And logically, you would anticipate that every single company in the materials space that has a project, at least on the whiteboard at this moment, is having active conversations. So I think you can probably still make money that way because at some point you have to ask, how does this all end? Is the government going to be trading out of these equity positions? It's not as though there's always a contribution that's coming with this. And at this point, I think it's safe to say that there is no end in sight for this.
Well, some people think that this is just the beginning of potentially U.S. sovereign wealth fund.
Sure.
Is that how you view it?
I mean, I think in some cases that's already very much the case, except, in theory, I suppose this is being done with taxpayer money. And you've seen some funds reallocated from areas like the CHIPS Act and some other funding. And I think it's really just going to try to accelerate a lot of these investment opportunities.
One official was talking about there's hundreds of deals that right now are being proposed.
Yep.
Could you see by the end of Trump's first term, hundreds of companies the U.S. government has a stake in?
In theory, sure. Look at all these stakes. And what's interesting about a 5 to 10% stake is some of these are coming with board membership, right? So the government is becoming an active member of management oversight, right? They're not necessarily helping with execution, but they can help on the contracting side. And if you think about, hundreds of companies out there taking a 5% equity interest in some of these companies that's coming costless to the government, sure, in theory, right? And if you're an executive right now and you see the potential to re-rate your equity by hundreds of percent, and then on the back of that, perhaps raise additional capital in the markets just by giving the company, the government 5% of your company, that's a very difficult deal not to sign.
But long term, what does this do for competition in this space?
Well, I think that it does welcome, at least in the United States, that everyone can get involved in the supply chain. Look at rare earths, for instance, right now. Yes, they've championed MP. They've given them a floor price. And you've seen actually the NdPr market for rare earths, you've seen pricing move substantially higher, up to $90 a kilo. In August, they gave them a $110 a kilo price floor. I think that it provides opportunity for everyone within the United States and really allied nations to come forward with projects to try to reshore the supply chain as quickly as possible.
I have a massive amount of sympathy for the national security objectives. Mm-hmm. It's the capitalist story that I worry about here. And bringing up the sovereign wealth fund, I hear this come up all the time. Sovereign wealth funds traditionally come from surplus countries.
Yep.
And they're recycling that money back into the economy. That's not this.
Right.
This is about taking money from the taxpayer and deciding that the White House is going to be the guy that makes the decision on where to invest it. That's going to completely distort market forces. Mm-hmm. This is a completely different thing. I'm not even sure you can call that a sovereign wealth fund, even if they labelled it one.
Yep.
The market distortions and what it could mean for a market-based economy like the one we have in America, one that's massively successful, by the way, and the envy of the world, I worry about that. And I'd also worry about what it normalises. It's okay when you have people who are in charge, who have experience of private markets. There are a lot of people down in Washington, D.C., who have never had a job apart from being a politician, who could find themselves in power after normalising this kind of activity. I would worry much more about the future in that. And we spoke to Bill Cassidy, the senator from Louisiana, the Republican, yesterday, who was just as worried. He was thinking about the kind of behaviour it's going to normalise in Washington and in the White House. And you might not worry now because your team's in the White House. Think about what would happen if someone from the far, far left gets into power, and the kind of objectives they've got, and what they'd like to invest in, and what companies they'd like to buy. And maybe you've got a different perspective on what this could mean in the future.
This is the reason why, as you said before, the U.S. is starting to look a little bit more like China. And who's in power, though, does change, unlike in China. And so there really is a question longer term of what kind of precedent this sets.
David, well explained. It's great to catch up. We'll do this again soon. David Deckelbaum of TD Cowen. David's point on the amount of capital this can attract, putting a spotlight on things and drawing people's attention to it, I think is a really valid point.
And it might actually be a really positive thing in terms of growth and in terms of developing an area that is crucial.
Up next on the programme, we'll catch up with Greg Daco of EY as he's raising the bets on rate cuts. Plus, Yahara has your morning move as FICO sliding as competition heats up in credit score services. Their stock is down by 2%. The opening bound about 60 minutes away. Equity futures on the S&P 500 firmer here by 0.1%. A lift in this market once again on the Nasdaq, on the S&P, on the Russell. Small caps higher by 0.4. With some single names, with the opening bound just around the corner. Your morning movers with Yahara. Hey, Yahara.
Hi, John. We start with Jefferies. That stock is now down 2.5% as we see the fallout from the collapse of First Brands. This bank is facing $161 million in exposure to the bankrupt auto parts supplier, which, of course, back in September filed for bankruptcy after investors questioned its trade financing. Meanwhile, FICO also taking a hit here down nearly 2% after Equifax struck back in the credit score battle. Equifax says that it will offer its Vantage Score 4.0 for just $4.50. That's more than 50% cheaper than FICO's model. The move is an obvious attempt to get mortgage resellers to switch to Vantage Score, testing FICO's grip on that market. And we end on AST Space Mobile. That stock is soaring 12% now in the pre-market after expanding its partnership with Verizon, which is also up. They're building the first space-based cellular network, and it would fill coverage gaps, making your phone work in rural areas and other places where it's difficult to get service. John?
Yahara, thank you. Appreciate the update. Thank you very much. Investors, of course, awaited the release of the September Fed minutes. They come out at 2 p.m. Eastern time with a preview. Let's cross over to Bloomberg's Mike McKee. Good morning, Mike.
Good morning, John. You're right. We actually get something to look at today on the economic side, and that is the Fed minutes, which ordinarily don't get as much attention as they used to, but today probably will, because there are a lot of things in there that people want to know. The first thing, of course, is the rate path discussion. Are they really talking about cutting rates again at the end of October and in December, or what could stop them from doing that? Are there hidden hawks? We only had one dissent, but are there people who would have dissented if they had been voters instead of just participants? And then, of course, what are their inflation and labor outlooks? Do they really think that the economy is slowing significantly and that's a much greater danger than the danger of inflation? And why, since they say tariffs are bleeding into inflation, why are they now at this point saying inflation is not as big a problem? And one other thing, John, that everybody's going to be looking at, of course, is what, if anything, they say about the balance sheet and whether they're going to stop running it down fairly soon.
So, Mike, another story as well I wanted to talk about with you is one that you emailed me about a little bit earlier this morning. It's odd for a central bank to talk about another central bank, but the Bank of England did just that this morning, Mike. Could you just explain what they said and how unusual it was?
Well, their Financial Policy Committee, which is basically the regulator over there in England, said in its twice annual report today that the Federal Reserve is at a risk of, because of the independence attacks by the administration, creating a significant market problem. If the Fed loses credibility, we could see markets fall significantly. And you're right. It's not unusual for central banks to talk a little bit about others. Andrew Bailey, the governor of the Bank of England, has been a strong defender of Jay Powell. But to put a warning out there that this could affect markets is a little bit more than we have seen in the past. They also note there's an AI bubble probably building, and they're concerned about that sending markets down. So the combination of things from the Financial Policy Committee gives us something else to worry about these days.
Matt McKee, thank you, sir. Appreciate it. Check out this quote from the Bank of England. Material bottlenecks to AI progress from power, data or commodity supply chains, as well as conceptual breakthroughs which change the anticipated AI infrastructure requirements for the development and utilization of powerful AI models, could harm valuations. A lot of words there, but ultimately they've said more about valuations than this Federal Reserve has.
It's clearly this is a concern for them. They don't have any control over this. If they cut rates, they're not necessarily at risk of fueling this bubble because it's a very different dynamic over in England. So I think it's easier for them probably also to say, hey, Fed, this is what you're doing. We don't want to have to worry about it, but we're worried about what you're deciding on any given day. It's a difficult moment. I think it's a pretty interesting comment on their willingness to talk about this.
Are you suggesting these are things that second-tier central banks can say that first-tier central banks can't?
I did not say second tier. You said second tier, for the record.
I was just asking.
But yes.
OK. Let's stick with the Federal Reserve, a first-tier central bank, at least for now. Greg Daco of EY, raising his rate cut bet, now expecting the Fed to lower interest rate at back-to-back meetings. Greg writing the following. This increasingly fragile backdrop, compounded by a data vacuum and policy uncertainty, is likely to tilt the balance of Fed policymakers. Greg joins us now for more. Greg, good morning.
Good morning.
No data, no problem?
No data means more caution when it comes to how business leaders, how economists, how Fed policymakers are going to react. I've been talking with a lot of business executives that are concerned about the fact that we're not getting a pulse on the economy. And as we were getting before this government shutdown, a lot of mixed signals. There's growing uncertainty as to the underlying pace of the economy. I think one thing that's key to remember is that there are three fragile pillars to the economy that all start with an A. You have essentially affluent workers that are supporting consumer spending. You have the AI investment boom and potentially a bubble there. And then you have the asset price increases. They're all correlated and they're all fragile. If you get any type of disruption to one of those three, that could portend to a slower economic outlook and then the need for more Fed easing as we navigate into 2026.
When you talk about caution, it seems to be a deceleration in growth or euphoria in markets, not necessarily the acceleration in inflation. Why?
Well, I think when you're thinking about the economy right now, what you're seeing is essentially the acceleration in inflation that is induced by tariffs. And the key question is whether this is an embedded acceleration in inflation or something that's likely to be transitory. And you and I have talked about this in the past. We are in an environment where labor market demand is softening. It's not because we're seeing slower payroll growth only. It's because we're seeing a hiring rate that's at a 12-year low. It's because we are seeing continuing claims for unemployment that have been gradually rising. It's because job cut announcements are up 55% relative to last year. So all of these indicators indicate softening labor market demand. notwithstanding the massive negative shock that we've seen in terms of net migration, there is underlying weakness and softness in the labor market, which means there's unlikely to be this desire to raise wages. And so what we're seeing is essentially this increase in prices, which is eroding consumer spending power. And in turn, businesses that have to contend with these higher cost pressures are not going to be hiring more freely. They're not going to be allowing for higher wages. And therefore, that's going to continue to weigh on income and on consumer spending activity.
There's a lot to unpack there. I just would ask, and I sound like a broken record because I ask this a lot, would really cutting rates help that picture in any way? Would it get people jobs, given the fact that ultimately a lot of companies are turning to AI and they have every capital market opening that they possibly could imagine?
I think that's the broader question as to how the Fed reacts to supply shocks. We are in this environment where what we're seeing is massive supply shocks to the economy, whether it's on the side of AI or on the side of net migration in the labor market. The Fed has a limited number of tools to address any type of imbalance in the economy. And in this instance, it's a supply shock that's leading to inflationary pressures and reduced growth volumes. Now, your question is very interesting because what we're seeing is essentially a growing spread between short-term rates and long-term rates. Short-term rates are pricing more Fed easing over the course of the next 12 months. Long-term rates have to contend with higher inflation expectations, a fiscal situation that is concerning, even more so in the midst of a government shutdown, and then Fed pressures from the administration. The three Fs there are very important to contend with when it comes to the trajectory of where the economy is going to head.
When you look at tariff-induced inflation, though, we haven't really seen it yet. Not broad-based.
Not broad-based, but if you lift the hood and you look at the underlying drivers of inflation, if you look at grocery prices, if you look at apparel prices, if you look at car prices, if you look at furniture prices, all of these elements have been rising and lifting inflation by about a third. Essentially, a third of the inflation increase over the course of the past 4 months has been driven by these categories. What I would also note is that you're also seeing that pass through to services. A lot of services that we consume are actually using goods and equipment. You think of medical care, you think of car repair shops. There are services that use a lot of equipment that have an imported component into them and that essentially see these upward pressures in terms of prices. We're not going to see the same type of increase that we saw back in 21 and 22. We're not going back to 9% inflation, but we are going away from 2% inflation towards 3.5% inflation, which is hurting families across the country.
Will this haunt the Fed next year? Because they seem to be ignoring it completely in the biases to the labor market.
I think you may see the hints of this hurting the Fed next year because the rotation of voters is going to be more hawkish. So if there is more easing this year, you're going to see more hawkish members next year that may be on the docket saying essentially, we ease too much, and we now need to either hold for longer or tighten monetary policy. That's going to be the 2026 debate because the rotation of Fed policymakers is going to become more hawkish.
It's super hard to predict what the Fed's going to do a year out. The Federal Reserve has difficulty predicting what the Federal Reserve's going to do a year out. Given what you just said, you're going to have this mix, this collision between a hawkish rotation and then maybe a very dovish rotation at the very top of the central bank. How difficult will this committee be to lead beyond May next year?
Extreme polarization is going to be the situation when it comes to the Fed. We're already seeing hints of that. There's 150 basis points spread between the most hawkish dot in the infamous dot plot of the Fed and the most dovish policymaker. So that polarization is going to remain firmly in place, and we're going to get a cacophony of speeches that go in different directions when it comes to interpreting the direction of the U.S. economy next year. And that's going to be very hard to read from a policymaker standpoint, but also from a business leader standpoint. Let's not forget, what we really are concerned about is the direction of investment, the direction of employment, and the direction of consumer spending. If you have a lack of clarity as to what the Fed's going to be doing, because it interprets conditions as either being extremely loose on the financial front, or because it sees that there's more of a drag from the labor demand side or labor supply side, whether there are different views, diverging views, very divergent views potentially, that's going to confuse policymakers, it's going to confuse investors, and it's going to confuse business executives as to what decisions they should make.
Greg, good to see you.
Always
Thanks
a
for
pleasure.
dropping by. Thank you, sir. Greg Daco of EY. So basically expect massive dispersion in the dot plot for next year and beyond.
So maybe we could do the 3Ds. We have the 3As. We have the 3Fs. I was smiling. I saw that. Now we could have the 3Ds. Dot plot, dispersion. That's all I got.
Okay.
Data dependency.
Data
dispersion.
dependency.
Nice. Good
Thank
save.
you. That's really
Trying
good.
to help her out.
Great save.
Clearly, I'm not as good at it as it is.
Got to think these through, Bramo. You know, okay. Before the show, let's get you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. New developments this morning involving Elon Musk's push into artificial intelligence. Musk's XAI is said to be raising $20 billion, including $2 billion from NVIDIA to finance AI chips for its Colossus 2 project. Sources telling us here at Bloomberg the deal, split between equity and debt, allows XAI to rent NVIDIA processors for 5 years. Teams from the US, Qatar and Israel are gathering in Egypt for final negotiations to end the war in Gaza. The US team includes US Special Envoy Steve Witkoff and President Donald Trump's son-in-law Jared Kushner. They'll join an Israeli delegation led by Ron Dermer, as well as the Qatari Prime Minister. Salesforce won't pay a ransom demand from a hacker who claims to have stolen client data and intends to publish it. The hacking group, known as Shiny Hunters, was planning to share information stolen during a security incident involving the third-party app SalesLoft Drift. The breach resulted in the theft of data from a number of organizations that use Salesforce. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Ella Hoxha of BNY as she says there is no need to cut interest rates this time from New York City. You're watching Bloomberg TV.
We are expecting a cut at the end of the month, in part because they may not get me more official data between now and then. The chair seems to have made the decision that they're in risk management mode. I think at least for the rest of this year, that is going to be driving the decision.
That was the former Fed Vice Chair Richard Clarida, now with PIMCO, joining us a little bit earlier on this morning as we count you down to the opening bell. About 43 minutes away. Equity futures on the S&P 500 shaping up as follows. Firmer by 0.1%, bouncing back by 0.1 on the Nasdaq and outperforming on the Russell, higher by 0.4. That's the price action. Here's the trading diary, a sneak peek of the rest of this week at 1 p.m. Eastern Time. A 10-year Treasury auction. 2 p.m. we get the Fed minutes. Also today, another round of Fed speak. Look out for all of that. On Thursday, earnings from Delta and maybe another round of jobless claims. Looking unlikely at the moment. Plus comments from Treasury Secretary Scott Bessent and Fed Governor Bowman in a fireside chat. That might be worth watching. Then on Friday, going into the weekend, Mitch, consumer sentiment. As we turn to the Federal Reserve, Fed minutes due out later this afternoon at 2 p.m. Eastern Time. Ella Hoxha of BNY Investments Newton writing the following. If we are indeed in a new regime where inflation is 3 to 4%, not 2, then there is no need to cut interest rates. Right here. Ella joins us now for more. Ella, welcome back to New York. Good to see you.
Good morning.
You don't think they should, but they will. So what are the consequences?
Look, I think the focus, has been clearly on some weakening data in terms of the releases we've seen lately, but also in terms of the jobs market more specifically. And our view is that that weakness is coming because of weaker supply of labor, driven by the net negative migration we're seeing now. And so it's perhaps the wrong feature to look at. So it's happening for some of the more benign reasons, and not necessarily because there is a need for the Fed to cut policy rates here. The other reason for that is because by doing so at an economy which, as we said, is still running with inflation above that original target, which seems to have been dropped, then certainly there are risks that come from the inflationary side down the road. And so, in our opinion, that's perhaps a risk to pay more attention to for the Fed. So cuts seem a little premature here.
So there's a 10-year auction, as John was mentioning, later this afternoon in the New York Times. There also is a 30-year auction. Would you be touching this stuff with a 10-foot pole if you really believe that there's going to be a reacceleration in inflation and a Fed that's cutting rates?
10 football. Look, I mean, in Treasury specifically, we're running short positions, not because there is no value in fixed income markets. There's plenty of places you can own bonds. We just don't think Treasuries offer compelling value here, given this inflationary risks.
Is this a U.S. story? Is this a global story? Is this a duration story? Or is this something that is more pernicious that has you just stockpiling gold?
There is a global phenomena to it. I mean, I think we talked about this a few months ago in this show about the long end of curves releasing across the world. So we've seen it in Japan, in the UK, and so on and so forth. France has also been obviously repricing fiscal risk. So there is this thing going on underneath the surface, and it's structural in nature. Pertinent to the US, I would say there's more inflationary risks coming with it. And so that's perhaps the way we would play it. There are other areas where it becomes a bit more of a fiscal concern. I mean, as we said, in the case of France, UK is a bit of a risk given we have the budget next year. But for the US, I would say it's specifically more inflationary.
When it comes to inflation in the U.S., how are you thinking about next year in terms of tariff-induced inflation? There's been different thinking on the program today. Some people saying we're already seeing the pass-through, others saying actually companies are absorbing it's about 75% of it.
I mean, net, I try to take a simple approach to it. Is it going to push the cost base up? The answer is yes. Can it push prices up? The answer is yes. I think for the initial stage, you see some absorption. It's more difficult down the line. I think that's, and the distribution of that base is different for all industries, different for all companies. But net, I would say is inflationary. But it's not the only driver, right? There are other drivers as well. And I think this labor market dynamic is an important one, as well as the fact that on core CPI, we're still at like 3.2. So we're no longer in these old days. That's number one. And number two, on the headline number now, if you get a diffusion index, you're getting more than 60% of the components of that diffusion index actually pushing above 3%. So there's lots of stuff brewing underneath the surface when we're actually still talking about will the Fed cut twice this year or not. I think that's kind of like less important for bond markets, and the stuff down the road, as you say, next year is far more important.
And possibly less important for the equity market as well. The focus at the moment seems to be AI. I want to get across to the latest story on NVIDIA. Ed Ludlow breaking some news in the last 24 hours. That news now confirmed by the man himself, Jensen Huang at NVIDIA. Ed joins us now for more. Ed, what's the latest? Just go through your reporting and what you've been learning.
Yeah, the structure is really important. So xAI needs a way to finance the GPUs for its data centers, Colossus 2 particularly in Memphis. They've set up a special purpose vehicle with this pool of investors. The target is to raise $20 billion for the SPV, $12.5 billion of debt, the remainder in equity. And essentially, the investor pool buys the GPUs, and xAI leases or rents them over a period of 5 years. In this case, what Jensen Huang has just confirmed in another network is that they are participating. Our reporting was that NVIDIA would put $2 billion into the equity chunk of the SPV. And what Jensen Huang was saying in that interview is that he regrets he couldn't put more money into it. He said it's not venture financing, nor is it vendor financing per se. But I'd say that's as close to a sort of ironclad confirmation as we're going to get, because the whole point of an SPV, as you know, John, is usually the participants do so because they want it to be discreet. You're not. You
just
don't
to
have
jump in, buddy.
who you are.
I don't want to be combative about this, but Jensen Huang doesn't get to decide what it is. That's what it is.
Right. Yeah.
That's what it looks like. That's what it smells like. That's what it is. Now, Ed, I understand what they get out of it, because that vehicle is going to buy ultimately what NVIDIA provides. What do the other investors get out of it?
Yeah, so I think there's still a lot of reporting to do on whether they end up with any xAI shares, but you basically get guaranteed returns, right? xAI doesn't take the debt burden onto its own balance sheet. But because xAI is funneling lease fees to this pool of investors, they are getting guaranteed pay, although, the specifics on the payment schedule we don't have yet. But the main point, John, is like the GPUs are a very big initial upfront capital expenditure, but they're also a depreciating asset, in part because in a year's time, the generation of chip that's installed will be obsolete anyway, but they lose their value over time. And so the investor pool know how much they're going to get paid back, whether be it monthly or quarterly or whatever. And all told, they can then work out later what to do with those then obsolete chips.
Ed, thank you. I'm looking forward to the coverage. Great reporting, buddy. As always, Ed Ludlow there on the latest with NVIDIA and xAI. Ella Hoxha still with us. Ella, wanted a final word on this. It is vendor financing. You're basically investing in your customer, and they're going to use some of this money to basically buy what you're providing. We've seen a bit of this building over the past month or so. Have we seen a sufficient amount that worries you?
We have early signs, absolutely, and there are warning signs for now because the backdrop remains still supportive. And we were just talking about further easing of monetary policy, right? And on the growth side, we have some warning signals, but nothing that's concerning. So it's perhaps early days. I mean, market is running with this, and sentiment is very bullish. But we are seeing some of the early warning signs, absolutely.
Is it something you want to participate in, though? And I think that's the issue. That's the challenge a lot of people have got. Shorting this is brutal. You know, that's one thing. Staying out of it is another. But participating when this is continuing is maybe a pressure thing for a lot of people, I think, at the moment, the pressure to participate. Do you feel the pressure to participate in this rally?
Perhaps not in some of the AI stocks, some of the big stories. Actually, we've been taking a step back from some of those across the funds. At least I manage with the team. But I know they're still loved and they're well held. I mean, all the concentration stories behind those. I mean, it's not quite the time to short them yet. I don't think we are that brave. But certainly you can get out of the way given the moves. I think there's a lot brewing as we've seen. This is developing every week. So the best thing to do, I think, right here, right now, is take your money and step aside.
Ella, thank you. Appreciate it. Thank you very much. Ella Hoxha there of BNY Investments Newton. We've had a range of opinions on this matter so far this morning. Nvidia higher by 0.9%.
It can go higher, which is the reason why people don't want to short it. It's sort of getting in front of a freight train. At the same time, the idea of locking in some gains seems to be gaining in popularity, and that is a conviction that we're seeing.
Fantastic reporting from Ed Ludlow and the team. Look out for more coverage from him and Caroline Hyde at about 11 a.m. Eastern Time for Bloomberg Technology. Our coverage will continue. Tomorrow we'll catch up with Christian Muller-Glissman of Goldman Sachs, Filmco Pirelli of JP Morgan, the former Deputy Assistant to President Biden, Amos Hochstein, and Richard Bernstein of RB Advisors. In the equity market, the rally resumes. Higher by 0.2% on the S&P 500. The opening bell about 34 minutes away. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.